access of the committee at any time. Before I begin, I will call up the two resolutions noticed for today's hearing, reauthorizing the committee's task forces on artificial intelligence and financial technology, and ask unanimous consent that the resolutions be adopted. Without objection, then such is the order. This hearing is entitled Digital Assets and the Future of Finance. The President's Working Group on Financial Markets report on stablecoins. I now recognize myself for 5 minutes to give an opening statement. Today's hearing is part of this committee's ongoing review of digital assets. This committee has been at the forefront of congressional oversight of cutting-edge technology in the financial services. Through our task force on artificial intelligence and financial technology and our digital assets working group of Democratic members, we have continued to explore how emerging technologies impact our financial system, including the emergence of cryptocurrencies. Soon after learning of Facebook's plans to launch a global stablecoin in 2019, I asked Facebook to immediately pause its work until regulators and Congress had an opportunity to review the project. I invited Mark Zuckerberg to testify at a hearing where we scrutinized their plans, and I led a bipartisan delegation to Switzerland to meet with officials to discuss their plans to oversee the Libra Association, which was later rebranded as Diem. After deep scrutiny from me, the members of this committee, and our nation's regulators, Diem relented and recently sold its assets effectively, and I hope permanently, ending Facebook's misadventures in cryptocurrency. I'm pleased that our committee's leadership on this issue has made an impact, including helping to focus the attention of regulators on these issues. Last December, the committee convened a first of its kind hearing with a panel of cryptocurrency CEOs, building on early subcommittees hearings to understand where crypto products, services, and technologies were heading and how they should comply with applicable financial regulations. From the start, our committee has recognized that the explosive growth of digital assets presents a variety of risk and opportunities for our economy and communities, especially communities of color that have been left behind by our financial system. Their voices must be heard in the decision-making and regulatory process. Today's hearing focuses on stablecoins, which are a subset of cryptocurrencies pegged to a reserve asset, such as the US dollar. Stablecoins are primarily used in the United States to facilitate trading, lending, or borrowing of other cryptocurrencies. Troubling investigations have shown that many of these so-called stablecoins are not, in fact, backed fully by reserved assets. Moreover, due to speculative trading and the lack of investor protections, stablecoins could even threaten U.S. financial stability. The President's Working Group on Financial Markets published its report on stablecoins, reviewing the regulatory landscape of this fast-growing type of cryptocurrency. The report outlined various risks that stablecoins may present to market integrity, investor protection, and illicit finance. The report also highlighted systemic risk concerns due to the threat of stablecoins runs when they are not fully backed. concentration of economic power concerns, and regulatory gaps in effectively overseeing the stablecoin market. These risks could harm both ordinary users of these products as well as our financial system overall. And the PWG recommended that Congress take action. As more people invest in and use cryptocurrencies, including stablecoins, the committee will continue its efforts to look at how they're affected many aspects of our lives and our financial system. In particular, regulators and policymakers must work to ensure that any innovation in this space is responsible, that it provides robust consumer and investor protection, that it mitigates environmental impact, and that financial inclusion is front and center. We will also continue to investigate the development of a U.S. central bank digital currency that may provide a safe, stable, and secure method of instantaneous digital payments. I thank the ranking member for his recent letter on this committee's approach on digital assets, and I hope to continue working with him in a bipartisan way as we move forward. I now recognize the ranking member of the committee, the gentleman from North Carolina, Mr. McHenry, for 5 minutes.
Well, thank you, Madam Chair, and I do welcome that bipartisan approach, and I'm grateful that we're undertaking these hearings to learn more before we seek to take action. Well, Undersecretary Lang, thank you, and I appreciate your participation today, today's hearing on behalf of the Presidential Working Group on Financial Markets. What's clear is we need legislation. We agree on that. Regardless of what some may believe, it's our job on Capitol Hill to develop legislation to direct regulatory action if there is to be regulatory action. And let me be clear, it's specifically the House Financial Services Committee that will lead this legislative effort and bring clarity to this ecosystem. Currently, there is no federal law to address digital assets. With nearly a quarter of American adults now invested in crypto, we must move quickly to put in place a framework that clearly defines the rules of the road. The good news is that Financial Service Committee Republicans have already laid the foundation for the work that must be done to maintain the U.S. as a leader in digital assets and the digital asset revolution. In fact, committee Republicans released a set of principles on the central bank digital currency question, one of which emphasized the potential that stablecoins hold if issued under a thoughtful regulatory framework. The working group report outlines a model that could be pursued. However, it does not take into account the full picture and array of options available to us. So let's break that down. We know that the Democrat debate here in Washington is focused in the last decade on de-risking the financial service arena. Beginning with Dodd-Frank, they've talked about de-risking banks in particular. And as you state in the President's Working Group report here, and as I expect many Democrats will say today, stablecoins are viewed as extremely risky. So what's the solution of this working group? How do they mitigate this alleged risk? Well, they make them all banks. They regulate them all as banks, and they give them a federal taxpayer backstop, which is completely the opposite direction we've been moving in for the last decade in Washington. We're trying to de-risk, not add risk to the federal taxpayer. So that doesn't make any sense to me. Now, let me be clear. I'm not saying that there's zero risk, but Washington's knee-jerk reaction to regulate out of fear will not allow stablecoins to achieve their full potential and the myriad of solutions that they may be able to present. This new technology, like all financial technology, deserves appropriate and thoughtful regulatory approaches. The report also includes an analysis of the stablecoin market. Yet in this analysis, in this paper, there was absolutely no discussion of existing regulatory frameworks for stablecoin issuers at the state level. These issuers are subjected to a comprehensive set of supervisory regimes, including reserve requirements, examinations, compliance with anti-money laundering rules, and that's being done in a couple of states. We should be examining all existing federal frameworks regulatory frameworks and structures for best practices and taking advantages of the lessons learned from those operating on the forefront at the state level. Another critical component missing from this report was the potential benefits of stablecoins, not just the risk, but the potential benefits. In this committee, we have witnessed the payments industry address shifts in customer and consumer demand and the never-ending race to move money faster, cheaper, and better. Digital currencies like stablecoins are a natural continuation of the same issues we've addressed in this committee over the years, and I might add in a bipartisan way. We cannot regulate out of fear of the future. It is Congress's role to seek solutions that directly address the risks at hand and ensure that the benefits are also part of those discussions. Requiring stablecoins to only be issued by banks would be a major obstacle for us continuing to foster innovation within this nascent industry. My friends across the aisle would like to force new products into unfitting and often inappropriate existing regulatory structures. I think we need to move forward and think of this in a new approach. And while I recognize the working group's inclination to do what has been Democrat orthodoxy, I hope that today we can think bigger and more comprehensively and discuss the potential benefits of increased use of stablecoins. The policies we develop must promote private sector innovation and foster competition to build a resilient product without creating risk in other areas. We should not, as this report does, limit our focus to only the risks. And we should not focus only at a federal structure. We should understand what's being done at the states as well. But to only focus on the risks, for instance, would be short-sighted and not allow us to realize the potential to the digital ecosystem of stablecoins and what the consumers want. So, Madam Chair, thank you. Thank you for this undertaking, and I hope we can have a thoughtful discussion about what is a really important subject matter for so many Americans and for us here on Capitol Hill. I look forward to working with you in the months to come.
Thank you, Ranking Member McHenry. At this time, I want to welcome our distinguished witness, the Honorable Nellie Liang, who is the Undersecretary for Domestic Finance at the United States Department of Treasury. Without objection, your written statement will be made part of the record. You will have 5 minutes to summarize your testimony. You should be able to see a timer that will indicate how much time you have left in your testimony. Undersecretary Liang, you are now recognized for 5 minutes to present your testimony.
Thank you very much for having me today. Chairwoman Waters, Ranking Member McHenry, and other members of the committee, thank you for the opportunity to testify this morning on the Stablecoin Report by the President's Working Group on Financial Markets, the PWG. The PWG is chaired by the Secretary of the Treasury, composed of the Federal Reserve Board, the Securities and Exchange Commission, and the Commodities Futures Trading Commission. It was formed by a presidential executive order in response to the 1987 stock market crash and regularly produces reports on financial market issues for the president, which may include recommended legislative changes. For the Stablecoin Report, the PWG was joined by the Federal Deposit Insurance Corporation and the Office of the Comptroller of the Currency. Stablecoins are part of an emerging set of digital assets, activities, and services that could have profound implications for the U.S. financial system and economy. The distinguishing feature of stablecoins as compared to other digital assets is that they are designed to maintain a stable value relative to a reference asset, often the US dollar. Stablecoins have grown rapidly from a market capitalization of roughly $5 billion at the start of 2020 to approximately $175 billion today. The PWG report focused on stablecoins because the offer of a stable value means they have the potential to be used widely as a means of payments by households, businesses, and financial firms. This potential use could create significant benefits for stablecoin users and payments transactions, but it could also pose risks. The PWG report focused on 3 prudential risks associated with the use of stablecoins for payments. First, run risk, a scenario in which loss of confidence in a stablecoin triggers a wave of redemptions, which could have broader spillover effects for the financial system. Second, payment risk, including operational issues that could interfere with the ability of users to store stablecoins or use them to make payments. And third, concerns related to concentration of economic power. For example, if a stablecoin provider scaled quickly and gained market power as a provider of payments. The PWG report found significant gaps in authorities that would address these prudential risks. Some of the largest stablecoin issuers operate with limited regulatory oversight, raising significant questions about whether their stablecoins are adequately backed. Even where a stablecoin issuer is subject to oversight, supervisors may not have sufficient visibility into the broader operations that support the use of stablecoin, which may be distributed among multiple entities. Neither state money transmitters nor securities law requirements were designed to address the financial stability, payment system, or concentration of economic powers for a payment instrument that is based on new distributed ledger technology. To fill this regulatory gap, the PWG report recommended legislation to ensure that stablecoins are subject to a consistent and comprehensive framework that is proportionate to the risks posed. Such legislation would complement existing authorities with respect to market integrity, investor and consumer protection, and illicit finance. Specifically, the report recommended limiting issuance of stablecoins to insured depository institutions, giving supervisors of stablecoin issuers visibility into the broader stablecoin arrangement, and authority to set risk management standards for critical activities related to the use of stablecoins for payment, and certain measures to reduce concerns about concentration of market power. In developing this recommendation for stablecoin issuers to be insured depository institutions, the PWG report relied on the flexibility that the banking agencies would have to adjust for differences between stablecoin issuers and traditional commercial banks, and to adjust to new products and structures that may emerge over time. As noted at the beginning of my testimony, stablecoins are a subset of a larger and quickly evolving digital assets market. The Treasury Department supports responsible innovations from digital assets, but is also committed to protecting against risk to users, the financial system, and the broader economy. The Biden administration continues to work across the agencies to develop a comprehensive strategy for all digital assets, with the goals of ensuring that cryptocurrency is not used for illicit finance, addressing risks related to financial stability and consumer investor protection, and furthering financial inclusion and our continued leadership in the global financial system. We look forward to partnering with Congress on these critical issues as we make progress, and appreciate the committee's leadership in this area. Thank you again for the opportunity to testify this morning. I would be happy to answer any questions from the committee.
Thank you, Secretary Liang. I now recognize myself for 5 minutes for questions. Ms. Liang, after much scrutiny from this committee, as well as from regulators, the Diem Association, which was founded by Facebook, announced last month that it had sold its stablecoin project to a bank, effectively exiting the cryptocurrency market. Facebook attempted many times to enter the cryptocurrency market, including in 2019, when Facebook formed the Libra Association in Switzerland to create a stablecoin. However, Facebook slowed down its activities after this committee held hearings and raised significant concerns, leading to a number of Libra Association members pulling out. To address systemic risk and concentration of economic power concerns, the President's Working Group report, among other things, recommends that stablecoin issuers should be required to restrict their activities to limit affiliation with commercial entities, similar to the separation we impose between banking and commerce. In your view, does that mean technology companies such as Facebook that have access to huge amounts of sensitive personal data should not be allowed to create their own stablecoin or other cryptocurrencies? And if they do, should they be subject to heightened scrutiny?
Thank you, Chairwoman Waters, for that question. I would answer that in two parts. I think first, the first question is, should technology companies be allowed to issue stable coins? And I think the report recommends that stable coins be issued by insured depository institutions. And in that sense, then stable coins would not recommend that stable coins be issued by technology companies. This is the issue of the separation of banking and commerce has been an issue that Congress has grappled with for many years. In this case, we believe stable coins as a payment instrument should not be issued by a technology firm. Second, there's a question of whether technology providers could be providers of other parts of the stablecoin arrangement, including custodial wallet providers and providing some of the other services involved with the use, the storage, the transfer of stablecoins for payments. The recommendation in the report is for Congress to consider this particular issue as to whether commercial entities could be providers. A more targeted solution that was included in the report is to consider restrictions on what wallet providers can do with the customer transactions data that they would have access to, and whether there are limitations on privacy and security that could address the concerns about concentrations of economic power if commercial companies were involved in the stablecoin arrangement.
Thank you. Stablecoins have grown at an incredible rate in the past year, going from 30 billion late last year to over 170 billion today. However, simply labeling something as stable or overly relying on one-to-one ratio does not in itself mean it maintains a stable value. We learned that lesson painfully when money market funds crashed in 2008 and needed a federal bailout to protect investors and markets. Recently, some stablecoin issuers had recently transitioned from having their stablecoins being backed by various forms of debt securities to now supposedly being backed only by the US dollar and short-term US treasuries. Do you think this is enough to address the systemic risk and the run risk concerns of stablecoins that the President's Working Group report highlighted?
So as we, thank you for the question. The stable coins that the PWG report focused on the function that they could provide because of their stable value to be used widely as a means of payment by households, businesses, financial firms, governments. We identified three risks. One is the run risk that you referred to, and that is the ability, if investors were to lose confidence in the quality of the assets backing the stablecoin, there could be a run which has potential systemic risk consequences. But in addition, stablecoin is not the stablecoin is not just the creation and redemption of the stablecoin. It is also, as a payment mechanism, involved in the operations that involve the storage, the transfer of stablecoins for payments. And that is what the President's Working Group added to the conversation, that part of the arrangement is also important for supervisors to have some visibility to, and to establish some risk management standards to ensure that the payment system remains, it retains its integrity. So one insured depository institution allows for sufficient confidence in the value of the assets backing the stablecoin. The supervision also allows some oversight of the overall payment arrangement.
Thank you very much. The gentleman from North Carolina, Mr. McHenry, who is the ranking member of the committee, is now recognized for 5 minutes.
Well, thank you, Chairwoman Waters, and Undersecretary Lang. Thank you. Thanks for your engagement and running point on this report. And I do appreciate the conversation that we've had and that you've had actively on Capitol Hill across the aisle. I think on both sides of the aisle. I think that's very good. But just so we're on the same page, I just want to make sure that we're looking at this in a similar fashion. Is there current federal law that governs stable coins or frankly, digital assets for that matter?
There are federal laws that apply to various aspects of stablecoin that address illicit finance, address stablecoins as an investment asset, and consumer protection laws would apply to stablecoins.
But nothing that's explicitly about stable coins.
Nothing explicitly, but
And that's what you try to address,
function. Yeah.
right? So yes, of course. And by that same measure, something 100 years in the future, we currently have law for. So it's a pretty expansive response you've given me. But there is no notion of a stable coin in current law or digital assets in current law that is explicit about those things. This wasn't meant to be a gotcha. The answer is no.
Yeah, I do not believe so. Yeah.
Right. That's it. I'm sorry. This was supposed to be the easy question.
That was silly.
So here, and I think we can have some consensus here on how we get ahead. But one area that I think this committee should examine is the current state regulatory frameworks. Did the working group consult with state regulators on their existing frameworks?
Yes, the working group did consult and talk to state regulators, and a number of state regulators have increased their expertise in this area.
But
the PWG report believes that a more consistent, less fragmented framework is preferred.
And does that also mean that the president's working group would think that we shouldn't have state chartered credit unions or banks? By that same notion, that would be like saying we only have federal banks. So to that point, you consulted with these regulators, but there was no mention of existing state regulatory framework. Why was that? Why did the president's working group make that decision to not mention existing existing frameworks and lessons learned from those existing, state frameworks?
Mm-hmm. The working group proposed a consistent framework.
I know, I understand what you proposed.
State regulators. So a proposal for an IDI could be a state chartered or a federal chartered bank.
But what I'm asking is a separate question, Undersecretary. Look, it's not an adversarial conversation. I think the fact that the administration's put out this report is a welcome thing, and you've given one solution to a really complex set of industries. But there was no mention of any state regulatory framework. We know that New York is the most active, and they have a very safe but very robust set of regulation and disclosures. But there's no mention of New York. There's no lessons learned from the states included in this report. I was interested in why that was, not the question of what you reported. I've read the report. So why not understand the lessons learned from the states, and why was that not included in the report?
Right. There's no explicit reason for why it was not included. It was certainly considered as an alternative. The principal reason is that the state regulatory system is fragmented. There is an issuer, and then there are the custodial wallet providers, the other parts of the arrangement that are subject to different kinds of regulations.
Okay, so
There is no plenary oversight of the entire arrangement.
thank you. I appreciate your response. By that same notion, you would like to have a single regulator at the federal level for all financial institutions. That didn't succeed in Dodd-Frank. Now, I do want to ask about de-risking, though.
Mhm.
In the report, you outlined that these are risky. This is an extremely risky proposition of stablecoins. But the conclusion here is that you should put them in a federally insured depository institution. With Dodd-Frank, we attempted to de-risk those institutions. And what you're adding to explicitly with this report is a riskier aspect that would have a federal backstop and the federal taxpayer backstop and the unwinding authority granted under Dodd-Frank for these institutions and specifically this product. Shouldn't we be in the game of de-risking rather than adding to the risk of a federal bailout or for these products?
So I think in the current environment, regulators are in a bit of an uncomfortable position. Stablecoins are increasing. They've grown rapidly, as you've said. There are risks. Regulation is about where those risks should reside and how to protect users and investors.
And
If stablecoins are backed by high quality assets, their risk is quite low. And they can form a building block, a cornerstone of a payment system. But if they are not supported and there's questions about the quality of the assets in the reserve pool backing them, then they create risk.
thank you, Madam Chair, I appreciate the extended time we both got to share on this. I
Yes.
do think the state regulatory framework we can learn a lot from of what they've done well and the things that we can do better.
Thank you,
I
Mr.
appreciate the
McKinley.
engagement and yield back the balance of my time.
Thank you. The gentlewoman from New York, Ms. Velasquez, who is also the chair of the House Committee on Small Business, is now recognized for 5 minutes.
Thank you, Chairwoman Waters, and welcome, Undersecretary Lin. I would like to ask you about the investigation that was conducted by the New York Attorney General Letitia James last year that revealed that starting in 2017, the stablecoin Tether deceived clients and markets by failing to hold reserves to back their Tethers in circulation, which was contrary to their representations. The President's Working Group report highlights the lack of standards of reserve assets as a concern and recommends legislation which requires stablecoin issuers become insured depository institutions. Can you elaborate on this recommendation and why it could create standards regarding the composition of the reserve assets and the information issuers make to the public?
Yes, thank you for your question. So the issues that you raise are extremely pertinent to the first risk that the PWG report identified, which is the risk of runs on a stablecoin arrangement because the quality of the assets, the composition of the assets backing the coin are not in fact able to offer stable value, perhaps in periods of stress. That is, the current market regulators have authorities to address, to promote market integrity and to protect investors. The proposal for an IDI is to bring the quality and composition of assets under a supervisory framework where there is a regulator who can attest to the quality of those assets backing a stablecoin. And there is a regulator and supervisor who can also oversee the entire arrangement for a stablecoin to be used for payments. So that is the core of the approach. We believe it provides clarity to stablecoin issuers in terms of a consistent framework versus state level regulations and money transmitter licenses in 49 states, and allows for beneficial innovation. In our outreach, the industry really asked for clarity so they could move forward and believed it would facilitate innovation.
Thank you, Undersecretary, for that answer. Secretary Lynn, Puerto Rico has become a favorite location for cryptocurrency speculators and investors from the mainland. And, you know, the mainland media, this is Bloomberg, this is Rolling Stone, CNN did a report, Wall Street Journal, another report. So at the heart of this situation is Puerto Rico's Individual Investors Act, which enables wealthy mainlanders who establish themselves as Puerto Rican residents to pay zero tax on capital gains, dividends, and interest, making the island particularly attractive for cryptocurrency investors. Would additional legislative authority from Congress be helpful to go after these crypto investors who are attempting to use Puerto Rico as a tax shelter and evade IRS reporting?
Congresswoman, I'm not familiar with the particular act, the Individual Investors Act, but the Treasury Department does believe and works by the principle that taxpayers should pay the taxes they owe. I believe maybe Treasury officials and IRS are looking at that issue quite closely with respect to crypto transactions. And we would be happy to follow up further on this particular situation.
Thank you very much.
Thank you. I yield back.
Thank you. The gentlewoman from Missouri, Mrs. Wagner, is now recognized for 5 minutes.
Thank you, Madam Chairwoman. Under Secretary Liang, the Financial Stability Board included high-level recommendations to provide for supervision and oversight of global stablecoin arrangements. A few of the recommendations include, and I'm going to highlight all 4 of them: 1, a comprehensive governance framework with a clear allocation of accountability for the functions and activities; 2, effective risk management frameworks with regard to reserve management, operational resilience, and cybersecurity safeguards; 3, transparent information necessary to understand the functioning of the arrangement; and 4, the legal clarity for users on the nature and enforceability of any redemption rights and the process for redemption, among others. These recommendations seek to address one of the critical issues, which is the potential for fraud and the mismanagement of reserves. In December, a number of CEOs discussed their operations before this committee, and it seems that based on certain issuers' existing regulatory structures at the state level, the requirements would meet these high-level recommendations and address a number of the risks highlighted in the report. Undersecretary Liang, do you share that same view?
Thank you, Congresswoman. I think the principles that you you laid out under the FSB are exactly the principles that the PWG report believes its recommendation are trying to meet. I think under the current regulatory framework, it does not meet all of those criteria at this point in the US.
I
And
can tell you that the CEOs that came before us, really, the regulatory structures that they set up and were working with, especially under at the state level, met these high level recommendations and addressed a numbers of these risks that were highlighted in the report. Do you
so
not agree?
we have talked to some of the states and have talked to supervisors, and I believe while they believe under some of the licenses, they have oversight of the issuers and a different look through a different lens at the wallet providers and the other kinds of entities that are involved in storing, transferring, allowing stablecoins to be used as payments. That's a different set of regulations under the money transmitters licenses. And there is not plenary oversight of the overall arrangement. And
Well,
if stablecoins are going to be used widely as a payments mechanism, there is a concern of trying to make sure that they can actually perform their function, that there's operational oversight of operations for cyber convertible risks.
let me just say this. It seems that we should be examining the best practices under state frameworks instead of pretending that they do not exist. Applying a uniform regulatory framework to stablecoin issuers will discourage innovation and push stablecoin activity and jobs out of the United States. We must, I think, ensure that any federal regulatory framework provides clarity and also ensures that the regulation fits the activity rather than simply overlaying traditional banking regulation over stablecoins. Undersecretary Liang, in your opinion, how can stablecoins reduce barriers to financial inclusion and lower transaction costs?
Yes, so I think the potential for digital assets and stablecoin to improve financial inclusion are high. It can reduce the costs of payments and it can help individuals who are unbanked or underbanked if they're more comfortable conducting payments on their iPhone than going into a banking office. So I think there is quite a bit of potential, and there are pilot programs to test the use of stable coins for cross-border remittances. And I think that's a very, positive, favorable development.
I would agree with you, and I thank you for your testimony. I have run out of time, and I yield back, Madam Chairwoman.
Thank you. The gentleman from California, Mr. Sherman, who is also the chair of the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets, is now recognized for 5 minutes.
Thank you, Madam Chairman, and thank you for having that hearing where we had Mr. Zuckerberg come before us, and we pretty much stopped the Libra, which would have been a cryptocurrency that had so much money and power behind it with Facebook and others that it could have emerged as an everyday currency. The ranking member talks about state regulation. I'll just point out that imagine if we didn't have any federal regulation of state chartered banks. The FDIC didn't propose any capital rules. The FDIC didn't do any audits. It would only be a matter of time before a state, there was a race to the bottom, and we would have banks operating in my state, chartered by some other small state, and those banks would be going bankrupt because they would have found the jurisdiction that had the lowest capital requirements. We're told to look at the benefits of these digital systems, but it's really just a potential or hope for benefit. I want a more efficient way to buy a burger, right now I use a credit card, and the burger company, the seller has to pay a 2 or 3% fee, or a debit card might cost 50 cents. But it's unfair to compare the alleged potential of crypto to the actuality or current system that we have now. If you're going to compare things, you got to compare current with current. Currently, if I want to buy a burger with a stable coin or a crypto coin, I have to find an Uber, get them to drive me to the one burger stand that's rumored to exist in Cleveland, Ohio, where you can use a stable coin or a crypto coin to buy a burger. But I can't find a burger here in Washington, D.C. We're told about the risks to investors, and they are substantial. And where the stablecoin invests in cryptocurrency, you have a joining of two risks. You have all the stablecoin risk with an unstable coin, and then all the risks of the underlying crypto investment. But we can't just look at investors. We have to look at the risk posed to our payment system. And that's why I'm glad, Madam Undersecretary, that your report focused on how stablecoins and cryptocurrencies are undermining the U.S. anti-money laundering and know your customer rules. I sense sometimes what a group that I call patriotic anarchists, who wave the American flag and cheer whenever law enforcement or tax enforcement is thwarted. Madam Undersecretary, you've got a tough job to get a bill through Congress because all the money and power is on the other side. You don't have a PAC. You don't have gangs of lobbyists. You don't have the arena in my city named, enforceantimoneylaundering.com. No, it's called crypto.com. What you do have is the credibility of knowing that the Treasury Department and your affiliated agencies are putting the national interests over the pecuniary interests of certain investors. But for that credibility to translate into legislation, you represent the working group, and so I'm going to ask you to do more work. Can you come before us and offer specific statutes that you think that we should adopt, rather than just a few sentences of explanation? Because if you don't do that, then there'll be some confusion. Anything that does pass will be considerably weaker than what you're recommending.
Thank you. We would, of course, be happy to work with the Congress on any proposals, and believe that proposals that include an IDI as an option are in the appropriate direction.
Well, I hope that, and I'll make the request formal, that you will take your recommendations and turn them into something very close to, or actually statutory language, so that we know specifically what you are proposing. I'm told that cryptocurrencies enjoy significant investment by those in disenfranchised and minority communities. Of course, that was also true of subprime lending. Are you concerned that low and moderate income people in our country, particularly those of color, will be left holding the bag if we see a collapse in cryptocurrency or stablecoin?
Of course, crypto assets broadly, digital assets broadly, have the potential for benefits, as you mentioned, but they clearly currently too many incidences of fraud, misleading advertising. And the member agencies, as part of the PWG, the SEC, the CFTC, are taking actions to try to protect investors and consumers.
Thank you.
Thank you very much. The gentleman from Missouri, Mr. Lukemeyer, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you for being here, Ms. Liang. In 2019, the average daily turnover value of the U.S. dollar constituted 88% of the foreign exchange market transactions globally. This dominance by the dollar in the global marketplace is a key reason why the dollar remains the reserve currency of the world. Existence of hundreds of different types of privately established cryptocurrency, in my view, presents a threat to the dollar's status in global transactions. However, stablecoins backed by the US dollar, I believe, present a unique opportunity to ensure the US remains the reserve currency of the world as the financial service industry adapts to new technologies of blockchain and cryptocurrencies. Despite this critical aspect of stablecoins, the President's Working Group on Financial Markets report on stablecoins does not mention global competitiveness as a key aspect of stablecoin development. I think it's a striking oversight. I guess I got a couple questions here. Do you have any concern about the numbers of these cryptocurrencies and how they're being established and how they're working? And with respect to stable coins, do you see an opportunity to be able to actually help protect the reserve currency status and enhance the US dollar? Where would you stand on some of those issues? And can you elaborate, please?
Yes. So I believe the importance of the US dollar and its position in the global financial system is incredibly important for the economic well-being of the United States. I believe the recommendations to require stablecoin issuers backed by the US dollar to be put within a regulatory framework that assures that they are in fact stable is the best way to promote the US dollar. Currently, stablecoins are being issued with limited regulatory oversight or outside the regulation, backed by the US dollar. So they are claiming stable value without any assurance that they can provide stable value. So I do strongly believe the PWG recommendations are highly supportive of ensuring the position of the US dollar in the global system.
Well, short of regulating and forcing them to do this, is there a way to incentivize these stable coins to use dollars as the medium to be matched against, in your view? I'm not a big fan of regulation, but by the same token, I think we have to understand, I think there's a threat here with these cryptocurrencies being utilized in a way. Fortunately, right now, everybody will either turn around and go back to dollars or the natural currency of their country to be able to eventually be able to get their investments back monetized. But is there a way we can incentivize the stablecoin folks to use dollars, or what? Have you looked into that at all?
So I think currently they have a natural incentive to use the US dollar because it is the global currency. I believe the incentives we need to put in place are to ensure it remains. And I think the role of the US dollar is based on the country's respect for rule of law, the strength of its institutions, its economic potential, the depth and breadth of the financial markets, not the technology per se, but it is important. So that is the critical element. It's the fundamental strength of the dollar, and the technology can reinforce it.
It's interesting you make that comment. I appreciate the fact that you believe that in order for stablecoins to be successful, we have to have a stable economy. We have to have a stable currency in this country, and that's the incentive. So it makes sense for us to continue to work hard to maintain our reserve currency and the stability of our money and our country's economy. Thank you for that. You talked a little bit about perhaps, theoretically, with regards to a run on stablecoins and cryptocurrencies. Has there ever been a run on one at this point?
I believe there have been on some smaller stable coins. As you know, this market is evolving very rapidly. At times, there could be 60 different stable coins pegged to the dollar or to another reference asset that might mimic the dollar. I believe there's been maybe one or two, but these have not been large stable coins at this point.
Okay. Very good. My time's expired. Madam Chair, thank you very much. I yield back.
Thank you very much. The gentleman from Georgia, Mr. Scott, who is also the chair of the House Agricultural Committee, is now recognized for 5 minutes.
Thank you. First of all, both Chair Lady Waters and Ranking Member Patrick McHenry raised some of my concerns as well. Undersecretary Leon, there is a significant portion of our nation's population, Blacks, Hispanic, Asians, and white people as well, who are lacking basic access to banking services, payment technology, and financial literacy. So, Madam Undersecretary, can you explain how stablecoins connect non-traditional banking populations segments to the broader financial system? And what are the guardrails, if there are any that exist, to protect these consumers?
Thank you, Representative Scott. I believe that stablecoins can promote financial inclusion by reducing the cost of payments, by making them faster and cheaper. If users are more interested and more willing to use technology on, say, their iPhone for payments, then they would be going to a bank and using a bank. So I believe the costs can be cheaper and the execution can be faster. And I think the pilot programs for using stablecoin for cross-border remittances is a good example of how stablecoins could potentially be used for payments in a significant way and in a way that reduces costs. And
But my specific points are, where are the guardrails? Do
So-
you have any guardrails currently in existence to protect these consumers? Because, Undersecretary, wouldn't you agree with me that absent a robust legal and regulatory framework, one with clear and effective consumer protections, there is a very real possibility that without that the entire market could collapse before our very eyes?
the recommendations of the PWG report try to get to exactly that risk, that stablecoins as a payment mechanism, in fact, offer stable value and can provide a strong operational payment structure. And that is the best approach to protecting consumers.
All right, and you sort of opened the door here to this president's working group report. Tell me, what are their recommendations? Where in this report are there recommendations to specifically ensure that as stable coins are adopted into our more mainstream market, that there are corresponding increases in protections so that ordinary users don't fall through the cracks?
So, in fact, the recommendations are built on the idea and the premise that stablecoins will be growing, continue to grow rapidly, and that the guardrails need to be put in place to protect users and
Okay,
investors.
in my short time left, what are these recommendations?
Yes. So
Tell
one
us what
is
it is.
Yes, one is they are to build on existing securities and consumer protection laws. They are a complement to those laws that exist. but to require stablecoin issuers to be insured depository institutions, to require that the custodians, the wallet providers, those who manage the reserve assets, to also be subject to supervisory oversight, to ensure the integrity of the payment operations. Those are, in my view, and in the President's Working Group view, the best way to protect both consumers and users and the payment system.
And do you have an enforcer in target, in process to enforce these recommendations?
That would be the role of the regulatory and supervisory framework.
Thank you very
Thank
much.
you very much.
The gentleman from Michigan, Mr. Huizinga, is now recognized for 5 minutes.
Thank you, Madam Chair, and appreciate you being here, Undersecretary Liang. The Undersecretary, I'm assuming you may be familiar, but I just want to make sure. At the end of last year, House Financial Services Republicans released a principles position to guide Congress's evaluation of potential proposals for a U.S. central bank digital currency. And in that document, committee of Republicans noted, and I quote, "If Congress contemplates authorizing the use of a federally issued digital currency, or I'm sorry, a Fed-issued digital currency, it should not impede the development and utilization of stablecoins, both those currently in circulation and those yet to be developed," close quote. So in short, we need to make sure that the private sector is leading the way. That is one of the concerns that many of us have had. And I'll continue to advocate for that because I think it's important to remember that that issue as we continue this discussion on digital currencies. I want to move on to my questions here. The SEC is a member of the Presidential Working Group on Financial Markets, correct?
Correct.
Okay. Well, just about a month or so before the release of the report, SEC Chair Gensler stated in an interview that stablecoins, quote, "may have attributes of investment contracts, have some attributes like banking products, but the banking authorities right now don't have the full gamut of what they need and how we work with Congress to sort through that," close quote. While that may not be the most clear statement of intent, it does suggest that the chair believes that Congress needs to act in order or for most or all stablecoins to fall under the SEC's regulatory authority. Yet during his testimony to the Senate, Chair Gensler stated in a somewhat contradictory way that, quote, "some of these tokens have been deemed to be commodities and many of them are securities," close quote. So I'm curious, will you be able to explain why the report did not include any analysis of policy issues under the securities laws as they pertain to stable coins? And was it discussed? And again, given that the SEC is a member of the working group, certainly if it wasn't discussed, why not?
Yes, of course. So the President's Working Group was convened to view stablecoins as a possible way to improve the payment system. And the mandate was to identify whether this new possible payment instrument, based on a new technology, would have the appropriate regulatory framework. And the goal was to identify gaps in regulation. As I've mentioned in my testimony, this proposal builds on existing laws and regulations that apply, including SEC regulations that apply to stablecoins as a investment asset or a security. So
Did I miss something? I mean, it doesn't look like there was any analysis that was actually done on that.
No, we did not include what the existing securities were, but what is unique?
Hold on. I'm sorry. Hold on.
As
I'm sorry, Madam Secretary, but it's unclear already. So why would you not do that analysis? If we don't have a clear picture, why would you not have done that analysis?
Yeah, so I think I would need to defer to the SEC for its enforcement strategy, for its strategies about how to address stablecoin, but its authorities are for market integrity, investor protection related to the redemption and creation of stablecoins,
Okay.
not for their use as a payment instrument.
I've got 1 minute left. And while I want to revisit that, I need to move on to this quickly because I need to have your opinion. In your written testimony this morning, you indicated that, quote, some have suggested that stable coins could be regulated either as securities or as money market mutual funds. Assuming that stable coins satisfy the definition of securities or MMFs, there is a further question as to whether these regimes would effectively address the prudential risks of stablecoins. And in your view, what are the parallels between MMFs and stablecoins, and what considerations would be helpful for us to consider?
Yes. So I think thank you for this question. So stable coins, let me start with money market funds that invest in government securities, high quality securities, as if that was the pool of assets backing a stable coin. Their investors purchase those with the expectation of earning the yield on the underlying assets. It is an investment asset. A stable coin can be purchased and used for payments, not necessarily investment. And that's what makes stable coins unique. They are that bank-like product that the SEC chair referred to, as well as an investment-like product. And that's why we believe there was a regulatory gap for which a new framework should be considered.
Gentleman's time has expired. The gentleman from Texas, Mr. Green, who is also the chair of the Subcommittee on Oversight and Investigations, is now recognized for 5 minutes.
Thank you very much, Madam Chair. Am I audible, friends?
Yes, you are.
Thank you. Madam Chair, I greatly appreciate you having this hearing, as well as the ranking member. And to the witness, I have always appreciated you, and thank you so much for what you've shared with us over the years. Let's talk for just a moment about a particular coin. As you have explained, I understand that this is not one of the stable coins, but let's talk about Doge, D-O-G-E, if I'm pronouncing it correctly. Would you agree that that is not a stable coin?
That is not a stable coin.
And one of the things that I've noticed is how it has fluctuated. At one time, it had a high in terms of its capitalization of over $80 billion. And now it's down to around $20 billion. And it seems that this was initiated as a point of amusement for some persons. And it became an investment tool for some other persons. Do you agree? Or well, why don't we take it this way? What do you see as the foundation for this cryptocurrency? What is the foundation for? What is it resting on?
So I believe, first I would say digital asset marketplace is evolving very rapidly. It's changing, it is ongoing change for a while, but it is built around a new technology that has the potential to radically change how different financial services will be provided. There is a lot of products being offered, services being provided that investors can evaluate. They should, in my view, have the information needed and evaluate the risks they take if they choose to invest in them. Mm-hmm. And they also should have the protections that current laws would apply to investors. But it is, I think it is difficult for us, for regulators, policymakers, to anticipate what this digital asset landscape will look like many years from now. And
let me ask this question. What are you investing in when you invest in this particular piece of cryptocurrency? What are you investing in?
I think you're not speaking about any particular product, but I believe that people may be investing in the adaptation of this new digital technology, this distributed ledger technology, to all kinds of services and its application. And I think there's a view among the industry that the more people invest in these kinds of assets and get comfortable with them, the potential for them to develop new applications continues to grow. So I think it is a very open question, which of the products currently being provided will be lasting and durable. But it is in a position right now that regulators and policymakers, I think it's very difficult to prejudge who the winners and losers will be.
Well, I concur with your notion that it's difficult to prejudge, but I would add this commentary. If you invest in nothing, there's a good likelihood that at some point you'll get what you pay for. And that causes me a good deal of concern because a good many people have assumptions that are not necessarily going to be comparable to the facts. And people who are investing in coins that have no fiat currency associated with them, I know of very little associated with some of these. Those investments are at a higher risk than some others. And that causes me a lot of concern. I do believe that at some point, we're going to have to look at coins, certain coins, literally as being without the law. They would be without the law because we can't allow certain things to happen. We just can't allow people to invest in nothing. Investing in nothing does not end well, it seems to me. There may be some rare occasion where you'll get some great benefit, but usually you'll get what you pay for. And I'm so grateful to you. Thank you so much.
Thank you so very much. The gentleman from Oklahoma, Mr. Lucas, is now recognized for 5 minutes.
Thank you, Madam Chair. Undersecretary Lang, could you discuss the differences between the types of reserve assets that stablecoins hold?
As I mentioned, there are many stable coins that are being offered that are tied to the value, say, of the US dollar predominantly. Some of them are backed by treasury securities, bank deposits. Some of them are backed by short-term liabilities such as commercial paper, corporate debt, others. Now, these are self-reported assets, which I believe are subject to audit by a private firm. They are not confirmed by any regulators, but there is a mix of the reserve assets backing stablecoins. And not all of them are, we believe, would be able to deliver a dollar in stress conditions.
Which takes me to my next question. If there is such a thing, what would a typical assortment of reserve assets be? You mentioned every one of these is unique in itself, but is there such a thing as a typical assortment of assets in these pools?
I think the desired asset pool would be high quality assets that could deliver a dollar even under stress conditions. And but I think the current mix varies across the different stablecoin issuers. As I mentioned, there may well be 50 or 60 different stablecoin issuers out there right now. The largest, however, does not has some corporate short-term liabilities that has not proven to to be able to deliver a dollar in the past under stress conditions.
Exactly, and that takes me to my last question on this line of logic, thinking about my predecessor from Texas comments. That mixture of reserve assets, of course, would impact a user's ability to redeem stablecoin at some future point, correct?
Absolutely.
So one would need to be thoughtful.
Absolutely.
Second question, Undersecretary. The CFTC has shown through enforcement action that it has some authority over stablecoins. Is it the working group's view that the Commodity Exchange Act gives CFTC the full authority to audit stablecoins to ensure that the assets are backing the stablecoins, are fully accounted for?
I would definitely need to defer to the CFTC, refer you to the CFTC on that view. The PWG did not try to come to a conclusion about the applicability of the securities and the commodities laws. That is something their agencies are working on. And as I understand it, there are enforcement cases in the courts that are addressing this issue. The PWG was looking for gaps in existing regulations related to stablecoins as a payment instrument.
The report touches on how many stablecoins aspire to one day to be used widely by retail users to pay for goods and services and other uses. Can you discuss the current barriers stablecoins might face in becoming widely adapted? And in your view, would the wide adoption of stablecoins be a positive development for the consumer?
I think the potential for stablecoins to be widely used is there's potential benefits, again, in faster and cheaper payments. The current barriers, when in our outreach, when we were doing this study, we spoke to, 40, 50 market participants. And one thing was a common theme was greater clarity about the regulatory structure would be helpful to developers and innovators on stablecoin. I also think it is at the beginning of adaptation. I think adaptation of technology can scale up very quickly. There's quite a few companies now considering whether to issue stablecoin and how to do so. I think the potential is there to really improve the payment system.
With that, Madam Chair, I yield back the balance of my time.
Thank you very much. The gentleman from Missouri, Mr. Cleaver, who is also the chair of the Subcommittee on Housing, Community Development, and Insurance, is now recognized for 5 minutes.
Madam Chair, and Secretary Liang, thank you for being here today and for being so candid with us. I am following in the same line that my colleagues, many of my colleagues have raised during this discussion. And Madam Secretary, I'm suffering from Ponzi paranoia. I know you probably haven't heard of that disease, but I when I start thinking about and discussing this whole issue, I think of Bernie Madoff and how easy it would be for us to have some kind of devastating economic problem as it relates to this whole new digital currency, digital dollars. And let me just find out, if there's any kind of antipsychotic regime that's put in place by you or other doctors. You're a PhD, right? So you're a doctor. I need a doctor on this anyway. So what protects the American public right now, at this very moment, from being taken in?
I think the issues that you raise are of serious concern that consumers and investors need to be protected. The digital asset space, while built on a new technology and while offering the potential for innovation that's beneficial to the economy and consumers, also carries some risks to consumers and users and investors. The market regulators, the CFPB, and the banking agencies, to the extent that their entities are involved, are taking actions to try to protect consumers and investors. And I expect these actions will continue. And they address fraud, misleading advertising, manipulation. So I think those are the protections in place. From a broader financial stability perspective, there is ongoing monitoring, following developments, and whether leverage might be used in some trading of digital assets that could cause the potential, increase the potential for a much more, even more serious fall in asset prices. So I think the regulators are very much focused on protecting investors and consumers. The PWG report focused on stablecoin, which has a more stable value. That's its offer. So it doesn't have quite that level of concern about the volatile asset prices that come along with the other assets. But I believe the regulatory community is very much focused on these issues you are raising.
Yes, I'm sure they are. But, you know, most of these private, the private sectors, they're setting up whole divisions right now of crypto divisions in corporations. They're ahead of us. And the reason I mentioned Bernie Madoff and Ponzi schemes, because, which is an investment fraud, all you need is a constant flow of new money to thrive. And when you face the reality that there are probably unlicensed sellers out there, and they're not registered with the Securities Exchange Commission. It frightens me. Do you have any such concerns?
Absolutely. I think new developing technologies, rapidly growing market with an unclear, inconsistent regulatory framework is not appropriate. And the PWG report tried to start the conversation of what the regulatory framework should be for stablecoins, which is a subset of the digital asset space. And as I mentioned in my testimony, the administration has an ongoing effort to take a more comprehensive strategy across all kinds of digital assets, including concerns about user protection and financial stability.
The gentleman from Florida,
Thank you,
Mr.
Madam Chair.
Posey, you're welcome. Mr. Posey is now recognized for 5 minutes.
Thank you, Chairwoman Waters. Secretary Lang, one of the reasons for a prudential supervision of banks and deposit insurance is to ensure that our payment system can redeem its deposit liabilities at par or dollar for dollar. This is essential for bank deposits functioning as money that can be redeemed even in periods of stress. In this regard, a number of questions have arisen in the stablecoin realm about asset quality. Let me use Tether as an example. Can you tell us if Tether is backed by a dollar or cash equivalent?
My understanding from their public documents that they post is that their reserve assets include assets that are not credit risk free.
Okay. Does Tether have investments in Chinese commercial paper or any other illiquid assets that might threaten the redeemability of otherwise stable coin?
I understand they hold commercial paper of private firms, which is not a credit-free asset.
Okay. Has Tether been issued that is not fully collateralized?
I'm sorry, could you repeat that question?
Yeah, has Tether been issued that is not totally or fully collateralized?
I expect that is the case. They are not regulated. They publish data, but based on what I understand, they may not be able to deliver they are not fully collateralized under all conditions.
Okay, thank you. Do you have concerns about Tether's opaqueness and its impact on consumers?
I do have concerns about the opacity of the reserve assets of stablecoin issuers. That is, in fact, one of the reasons for our first risk that we identified, the run risk, and the potential that could have for other short-term funding markets if investors were to become concerned about the quality of the assets underlying a stablecoin.
As we move forward, I hope we can find a path that provides for protection of consumers and investors in the stablecoin realm, but also permits our economy to realize the benefits of the newer innovations, of course. The President's Working Group explored regulatory alternatives to doing this. The conclusion that the group reached seemed to be that stablecoins ought to look more like banks and deposits, including deposit insurance. Can you share with us the alternative regulatory regimes for providing adequate disclosure that would make clear to consumers how stablecoins are not perfect substitutes for cash or bank deposits as they're currently structured anyway?
Mm-hmm. So as I mentioned in my testimony, the IDI proposal that issuers be IDIs really did rely on the flexibility of supervision and regulation under that proposal. That a stablecoin issuer that only issued stablecoins for payments and did not make commercial loans like a commercial bank, traditional commercial bank, would be subject to a very different supervisory regime. So I think there's a degree of flexibility within the proposal that we put forward. The PWG report also did not make a statement about deposit insurance. Depending on the quality of the assets and the capital and liquidity standards that could be applied to a stablecoin issuer, they may not need deposit insurance. So I think that is also a possibility in that within that one framework of IDI, there's a range of ways that could be applied.
Okay, and you've covered part of it already, but wondering what the current administration policy proposal for addressing stablecoins is in our financial system.
Currently, the PWG report recognizes that there are gaps in the current system, that there are securities laws and there are consumer protection laws and there are illicit finance laws to address stablecoins and other virtual assets. But there is not regulatory framework at the federal level that builds on state level regulations that would apply to stablecoins as their use of payments by households and businesses and financial firms and governments if it became widely used.
Well, I thank you for your forthrightness in answering it, and I see my time has expired. I yield back, Madam Chair.
Thank you. The gentleman from Colorado, Mr. Perlmutter, who is also the chair of the subcommittee on consumer protection and financial institutions, is now recognized for 5 minutes.
Thanks, Madam Chair, and thank you, Secretary Liang, for joining us today. I mean, this is a very interesting conversation because it's almost like we're trying to talk about the nature of money or the nature of an investment or the nature of commodities. So even though there's a glossary of new terms dealing with digital assets, we're dealing with some things that are very basic to, an economic system. And so for me, I just see there's a spectrum here, and you're trying to figure out on the spectrum, where do these stable coins fall? The first part of the spectrum would be, you go buy something, it's a stupid purchase. You should never have bought it, but we have caveat emptor, buyer beware. Why did you buy that dumb thing? But then say 10,000 people buy it, and you say, okay, well, and it falls apart. Well, you guys got defrauded, maybe, let's take a look at it. You move farther ahead and 1 million people invest in something. Now, all of a sudden, you got other questions you've got to ask. Is it a currency? Is it a medium of exchange that so many people are using? And I want to thank Mr. Davidson convened a group a couple days ago on cryptocurrencies, and it was very interesting conversation. So here, you know, it reminds me of money markets. It also reminds me of the silver certificates. It isn't like we haven't had in history something backed by what was thought to be stable, you know, reserve being silver, but then there was a crash of the silver market and those silver certificates were absolutely worthless. So in this instance, in this spectrum, where do you, I mean, these stable coins, what do you consider based on the review of the group? What is the most, what would you consider the most secure of the stable coins that have been developed? And not to the point where they're, you know, a currency, a medium of exchange that 1 million people are using back and forth. So, but more like an investment. I mean, can you see this sort of spectrum that I'm talking about?
Yeah, of course. And I think you highlighted the particular uniqueness of stablecoins, that it can be both the investment and it can serve as a payment mechanism. And the PWG report was focused on the future of stablecoins, the near future of stablecoins as a payment mechanism. But as a investment contract, there are, I understand, I believe, stablecoins that are backed by high quality assets. And if they were not used as payments and there were not issues of concerns about operational risks of storage, transfer, the actual use as payments, then they would not be, you know, the PWG recommendations are not applicable. The PWG recommendations are focused on those that could be used for payments and how to convert convertibility and operational risks as well.
So let's talk about that. So this is where it gets to money markets.
Yes.
And we broke the buck, you know, the reserve, whatever
Twice.
it was, twice we broke the buck. And Ms. Wagner and Mr. McHenry were sort of saying, well, why are we trying to, you know, make this a federal issue? Well, let's just go state by state. Well, we saw with money markets, even though we didn't back them, because so many people used them as currency or as a payment medium, we ended up backing them.
Right.
So the question is, do we want to do this before something goes to heck or after it goes to heck? I mean, that seems to be the question to me.
Right. The PWG report would suggest before.
All right. Well, I think this is a great education on sort of an economic system and the payment system. And I wish you very good luck in trying to come up with a good answer. Thank you.
Thank you very much.
Thank you very much. The gentleman from Kentucky, Mr. Barr, is not recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Undersecretary Lang, for your testimony. I want to follow up the questions from Mr. Luetkemeyer a little bit about protecting the dollar as the world's reserve currency. As innovations in digital assets advance, it is vitally important that we maintain the dollar's position as the world's reserve currency. Given that major stablecoins are denominated in dollars, the adoption would likely not compromise the dollar as the world's reserve currency. Number one, Undersecretary, do you agree with that? And secondly, do you agree that as dollar-backed stablecoins such as USDC are adopted, the threat to the dollar from cryptocurrencies and other central bank digital currencies is diminished?
So I agree with your statement that it is important to preserve the value of the dollar. I believe stable coins that are stable and can deliver a stable value tied to the dollar would be would benefit the US dollar.
Great. The Fed is exploring a digital dollar and recently released its long-awaited CBDC report. We don't want the development of a Fed CBDC to quash private sector innovation, including in the stable coin space. Do you believe that stable coins issued within a clear regulatory framework may be able to coexist with a Fed-issued CBDC?
Yeah, in my view, regulating stable coins tied to the dollar does not in any way preclude anything with respect to the introduction of a CBDC. It is hard to know what the future will look like, but one could imagine they could coexist. One could imagine a CBDC that supplants private stable coins, but I don't see any reason that the current creating a regulatory framework for U.S. stable coins would diminish any, foreclose any avenues on the digital dollar.
Well, one editorial comment, and I'm still developing my opinions on this, but it does seem to me that the dollar-backed stable coin concept solves the problem of protecting the dollar as a world reserve currency, and perhaps diminishes the case for a Fed central bank digital currency. Let me ask another question, though. I want the United States to be competitive and the leader in stablecoins, and one of the key recommendations of the PWG is that Congress pass a law requiring stablecoins to be issued only by insured depository institutions, bringing stablecoins within the banking regulatory regime. I do worry that this could push crypto talent, innovation, and stablecoin issuers overseas to other jurisdictions, and I also worry that it's inconsistent to take the position that only banks should be allowed to issue stablecoins, but then fail to grant bank charters to the largest issuers of stablecoins. As you think about American competitiveness and making sure that we're on the cutting edge and the leaders in this space, can you address these concerns in the context of the PWG's recommendation that we bring stablecoin issuance into the bank regulatory regime?
The proposal for issuers to be insured depository institutions is designed to make them stable. And I think stability is probably the key attribute of a good stablecoin. So I think stability and leadership in this space are not in conflict.
Undersecretary, that's a fair point. And if I just may interject with limited time, if you have an audit, if you have oversight of the integrity of audits to ensure that stablecoins truly are stable, that diminish the likelihood of run risk, for example, that to me solves the problem without requiring stablecoin issuance to be done through insured depository institutions. Why is that wrong?
The first risk that we identified in the report was run risk. The second risk was risk to the payment system. And that I do not think the disclosure or the money market fund type regulations are designed to address.
Well, thank you for your work on this. I look forward to continuing to be an advocate for innovation and American leadership in this space. And I yield back.
Absolutely.
Thank you. The gentleman from Connecticut, Mr. Himes, who is also the chair of the Subcommittee on National Security, International Development, and Monetary Policy, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Secretary, for being with us. Like Mr. Perlmutter, I think this is an interesting conversation. I want to just start by level setting, because I think it's important that we move on beyond what we have been doing in a constructive way and understanding these implements to realizing that, like every other innovation that the Congress has faced probably for centuries, there's potential upside, potential downside. My guess is that 110 years ago, when we were presented with the concept of the automobile, we never imagined that 35,000 Americans would die every single year on the roads because of the automobile. But nobody's proposing that we do away with the automobile. I suspect that's true for air travel, for the internet, for all of the innovations that we see every single year. So the question really is not, should we allow it or not? It's here. And the question is, just as it was with the automobile and with the internet and with everything else, how do we regulate it in a way that allows for innovation and the benefit, but protects the consumers, et cetera? And by the way, I'll just remind my colleagues, we famously did any number of hearings on GameStop back in February. Had grandma bought GameStop in February at $350 a share, grandma would be out 2/3 of her money today. And we don't say we should stop trading in GameStop. We say it should be transparent. It should be disclosed, all of the risks. And when that happens, we trust American consumers to take informed risk. So that leads me, Madam Secretary, to my question, which is, I think you'd agree with me that there is a radical difference between a stablecoin which is fully backed dollar for dollar with reserves that are not leverageable, where there is redemption at par, where there is no maturity transformation lending other bank like. There's a radical difference between that and what Mr. Green so memorably called investing in nothing, correct?
Agree.
Dogecoin. And I think we've got an opportunity here to recognize that by saying that if a stable coin is dollar for dollar backed with currency, it's redeemable at par, there's good transparency, we can regulate it in a way that is different than a much more risky instrument. And we've talked about this, but I wonder whether you would agree that full IDI regulation, bank charter, may not be necessary in that former case.
So I agree there are important distinctions between stablecoin and the unbacked digital assets. I also agree the full set of bank regulations do not need to be applied to a stablecoin issuer that does only stablecoin issuance. There's flexibility within the IDI framework to not focus on credit risk of making loans, because the stablecoin issuers do not make loans. They don't engage in fractional reserve banking. But they do have payments, and there are operational and convertibility risks that are associated with that you would like some oversight to ensure that the payment system continues to operate well, which is a public service to the financial system. And so that is the core of the PWG recommendation.
Yep. No, and I appreciate that. And I appreciate the way we've had a couple conversations about this, the way you're thinking flexibly, because I really do think our sole job right now is to figure out how to adequately regulate instruments which can be very, very safe or potentially very, very risky. And that's actually an exciting endeavor, I think. Let me use my last minute, Secretary Lang. Something I haven't thought too much about, but I'd love to hear you on for a minute, is systemic risk. It doesn't feel to me like you've got quite the market cap yet to create, or leverage, and I really highlight the word leverage, to create the kind of systemic risk. And I am a refugee of 2009, 2010. But give us a minute on what we need to watch for vis-a-vis the development of systemic risk in this space.
So I think you have identified one of the key things you would watch for systemic risk. It's an asset, it's an asset which the value becomes increasingly based on more leveraged positions. The regulators, including the Financial Stability Oversight Council, have been monitoring developments in digital assets, looking for leverage. Leverage is a fundamental vulnerability that increases risk to financial stability. Others are whether they become much more interconnected with the traditional financial system. So currently, crypto assets, digital assets have pretty tenuous links to the traditional financial system. And, the banking regulators have raised capital requirements on any crypto asset holdings. They are cautiously issuing guidance for how banks can get involved in this category. That's another thing if you were monitoring for emerging systemic risks, you would look for greater connections with the traditional system, and you would look for leverage, increasing leverage.
Thank you very much.
Thank
The
you.
gentleman's time has expired. The gentleman from Texas, Mr. Williams, is now recognized for 5 minutes.
Thank you, Madam Chairman. Cryptocurrencies have shown a great promise to fill many shortcomings with the traditional financial services marketplace. They're offering new ways to reach unbanked communities and are making it easier to send payments anywhere in the world, and are making oracles that transfer real-time data to blockchain networks. Stablecoins play an integral part in making this entire ecosystem function by allowing people to remove the volatility that is often associated with cryptos. So you can preserve value without the need to transfer digital coins back into fiat currencies. Your report suggests that we should treat all stablecoin users as banks. Now, this would give massive advantage to all of the institutions who are most skeptical about cryptocurrencies in the first place, and leave behind the entrepreneurs that have worked to make cryptocurrencies more mainstream. It would guarantee that the largest banks in the country have built-in advantage over other market participants who may not have the resources to comply with the minimum regulations that are coming. So this would give the largest banks an even greater advantage in this developing space over every other entrepreneur that may have been doing this much longer. So, Ms. Lang, how did the working group balance the effect on innovation as they came up with these recommendations?
So thank you for the question. Of course, the group was very focused on balancing the benefits for financial innovation with reducing the risks to users and the broader financial stability of stablecoins. I believe that stablecoins, because they offer stability, should be held accountable to actually be able to provide that stability when demanded. And that requires more regulation than they currently are under. While the proposal was for stablecoins to be issued by insured depository institutions, the proposal was also relied on the fact that regulation and supervision of IDIs can be quite flexible, and that stablecoin issuers that have a simple business model of holding high quality reserve assets and issuing liabilities such as stablecoins would be subject to a very much less stringent type of supervision and regulation than would a traditional commercial bank. So I think that we, the PWG, came out balancing the risks that could be reduced by that framework while providing clarity and consistency and safety that would be beneficial for innovation.
All right. As you developed this report, you sought the input of the regulators, academics, private sector participants. And as a business owner myself, I value the input of the private sector. I think it's the most important. And since most people who took risk to build these new products and provide services are private sector, they are the ones who took risk and have the most to lose if the government gets this regulation wrong. So in closing, can you describe your work in consulting the private sector as you developed this report, and do you think their voices were adequately accounted for?
We did reach out to many stakeholders, including academics, regulators, and private sector. We talked to many of in the industry to hear their concerns, to learn more about the actual business and the problems that they face. I think many of them are comfortable with the idea of a IDI bank charter. Some are pursuing it. Some are already within the regulatory perimeter, even on their own. So I think, again, we're balancing innovation with safety, trying to find the right balance. I think this recommendation is one path forward. Of course, Congress will determine how it wants to write legislation. We believe this element could be very beneficial to the system.
I yield my time back. Thank you.
Thank you very much. The gentleman from New York, Mr. Meeks, who is also the chair of the House Committee on Foreign Affairs, is now recognized for 5 minutes.
Thank you, Madam Chair. Madam Undersecretary, as mentioned, a core recommendation of the President's Working Group is to require stablecoin issuers to be insured depository institutions. So my question to what extent was this recommendation analyzed through the context of the President's executive order on promoting competition, as well as his executive order on racial equity? It occurs to me that limiting stablecoin issuance to insured depository institutions, which have a high barrier to entry, could limit competition. Furthermore, given the disproportionate amount of people of color that gravitate to non-bank financial institutions, such recommendations could have a racial equity impact. So what I want to know is, did the working group consider this recommendation's impact on both competition and racial equity? And if so, please explain.
Thank you. So the group did consider the impact on competition. I think the view is that the current regulatory framework is inconsistent, fragmented, and that a more consistent, comprehensive framework would benefit competition. It also believes that financial innovation is important and tried to provide clarity, which is something that the industry has asked for. And that also that competitive advantages should not arise from how differences in how standards are implemented across different regulators. So my view is that it balanced competition by providing more clarity, more consistency. In terms of meeting the needs of meeting equity goals and meeting the needs of unbanked or underbanked, I think stablecoins has potential to help by lowering costs. And if those who choose not to go to banks are more comfortable using the technology of the stablecoin. And so I think that is the potential for to improve financial inclusion and address some of the equity goals of this administration.
Well, thank you for that answer. And you know, there are certainly areas of regulatory gap when it comes to this new type of payment system and technology. And there are also tremendous ways we could use stablecoin to help underbanked communities. And as Chairwoman Waters said, I'm Chair of Foreign Affairs, so also, well, it could help communities abroad who may be facing turmoil in their home countries.
Yes.
And we're hearing about NGOs who can assist refugees with assessing their cash in their new country through the use of stablecoin.
Yes.
For example, if the population of a country in distress can access a mobile crypto wallet, then the government cannot get to it, making it a great use case for humanitarian aid and relief. So how can the Treasury assist some of those NGOs in partnership with stablecoin issuers to help get humanitarian aid out to these populations safely and efficiently? And is there anything that Congress can do to assist in this area?
So the examples you cite of being able to provide aid to other countries is exactly some of the benefits that could come from this new technology. The President's Working Group recommendations are to make that service, that product, more stable so that it functions as needed without raising other risks to financial stability. And so that is exactly an example of the beneficial effects of a new technology and allowing for innovation.
Well, thank you for that. You know, and I'm pretty pleased to see that the industry is interested in using stablecoin to help citizens of some foreign countries, and a lot of them are going through the necessary steps to ensure that there are proper anti-money laundering and know your customer procedures in place. But in a peer-to-peer transaction, that doesn't have a formal broker. FinCEN's jurisdictional reach is limited, and many crypto users value the autonomy aspect, and therefore a great number of transactions don't require the same level of KYC procedures that others may do. So, and I know I'm out of time, but my question would be, what role can the Financial Action Task Force and FinCEN play when it comes to combating these bad actors, while also ensuring that good use cases like humanitarian aid and simple cross-border payments are not stifled or made more complicated?
And Treasury is leading the Financial Action Task Force, the FATF force, and trying to improve the implementation of standards in countries that are maybe lagging in their implementation. This is a high priority for them.
Thank you very much. The gentleman from Arkansas, Mr. Hill, is now recognized for 5 minutes.
Thank you, Madam Chair. Thanks for convening this hearing. I appreciate the comments of the ranking member as well. Madam Secretary, thanks for sitting there patiently with all these members asking questions. You know, my sense listening today, Chair Waters, is there's a fair amount of agreement between Democrats and Republicans on stable coins, starting with the belief in their potential to improve the efficiency, speed, and cost of payments, especially cross-border payments, as just noted by Chair Meeks, expand financial access, and facilitate the use and adoption of digital assets due to the role of a stable coin as being sort of an on-ramp to the greater crypto developing ecosystem. I'd say very fledgling, but developing ecosystem. And as noted by Mr. Himes and Mr. Barr, maintaining the U.S. as a preferred currency, obviously important to all of us. Mr. Himes and I have our U.S. dollar legislation pending about working on that, but also the U.S. as a preferred place for innovation and host country for financial technology. So as Congress considers legislating, I think we ought to focus on permissible reserve assets, their credit quality, and the Collateral Act requirements, liquidity and redemption requirements, risk management and other governance issues, including audit and transparency controls and privacy. And look, irrespective of what the use case is. And this is something, Madam Secretary, this issue of whether it's acts as a money market mutual fund or a payment system, I think we ought to be neutral on that. I don't think we should preempt that. I think we ought to have narrowly crafted legislation that simply determines, as I've just outlined, what's a good stable coin from a consumer or a business point of view. Do you agree that we should focus on that definition above all after working on the output of the working group?
Representative Hill, thank you for that question, this thoughtful question. I think regulations should follow the function of the product or the service.
Yeah, I agree with that. Just my time short. I'm an activities-based person as opposed to jamming everything through entity regulation, particularly in an innovation, which is the jury's out for me on whether these have to be issued by a depository institution, for example. I don't think you're wrong to suggest that, but would you support a federal money transmission license or a national payment provider license that would be a national license similar to what we see in the EU? Is that an alternative that you would accept?
I think that is a possibility definitely worth exploring. The U.S. does not have a federal money transmitter license, and so we did not build on that framework.
Yeah. Well, and that gets into this issue Mr. McHenry asked about state regulation. Are you supportive of states going ahead and defining some of these quality standards around stablecoins as we've seen in the instance of New York?
I think in the current environment with stablecoins already in play and growing rapidly, the current regulators need to take actions to meet their mandates. As I understand it, some state money transmitter licenses don't even apply to digital assets. So it feels like there's probably room for different states to be revisiting their rules.
Yeah, thanks. And on the subject of deposit insurance, I agreed with a lot of the comments that I don't really think that's the right road to go down for these assets. I think defining them is a much better approach, whether they're used as a transaction payment activity or as an investment holding activity, and that we just use activity-based regulation based on the definition. As to whether or not they're systemically important, that seems a stretch for me at 150 billion or 170 billion. When you think about, we have 5 trillion in credit card transactions a year, and we have almost 5 trillion in money market funds. So to me, I thought that was a stretch. I encourage my colleagues to let's work together on a narrowly crafted definitions bill for what's a good stable coin. Thank you for your time, and I yield back.
Thank you very much, Mr. Hill. And I just want to remind you that while you talk about, it appears that there is growing consensus between both sides of the aisle, do not minimize a permissible reserve. That's very important. Thank you. The gentleman from Illinois, Mr. Foster, who is the chair of the task force on artificial intelligence, is now recognized for 5 minutes.
Thank you. Am I audible and visible here?
Yes.
Okay. All right. Well, I'd like to follow up regarding any specific recommendations that you might have for providing a secure and legally traceable digital identity for participants. You know, it seems to me that it is clear that if stable coins or even central bank digital currencies or other crypto assets become generally available for consumer transactions, and we want to prevent them from being used for ransomware, money laundering, human trafficking, you name it, we must have a legally traceable identity to the beneficial owners behind the transaction that can be executed in a court in a trusted jurisdiction in a country that we have extradition treaties with. And I thought it was quite remarkable that when we had the crypto billionaires in front of our committee a while ago, they pretty much agreed that that was a necessary condition for preventing this kind of crime. And we can't simply just use KYC requirements as they exist today, because you know the fact that someone or some shell company has a bank account in Cyprus just won't cut it. And so what are your thoughts on how to proceed with traceable digital identity for crypto assets generally, both nationally and internationally? And do you need more specific guidance from Congress on how to proceed?
Thank you for that question. So I think in the context of digital assets, the principles of security and privacy can at times be in conflict, but privacy is very important, as is security. I think the legislation this is an area for legislation. The PWG report did not make any recommendations around this issue, but I would say that they were very aware of this potential. And I think with the role of CBDC, these are issues as well. One area that the PWG report did touch on this topic is the potential for a stablecoin to scale rapidly, perhaps because of network effects. And there are benefits to that. But that also gives them quite a bit of information and control over a lot of customer financial transaction data. And how does one, so an issue that we raised was Congress should consider whether they would want to put some authorities around how to manage the security of that data. And I think that's an important issue to address if digital assets as a currency become, widely used and by the population. And, you have a big system where everything is digital. As you know, consumer privacy is important, and as well as security, and those are a balance. And I think that's an area for Congress to be doing more in, as they are, I should say.
Yeah, and so I just would, as I've done before in this committee, draw people's attention to the NIST standards for using a modern cell phone and a Real ID compliant a mobile ID or driver's license as a way for consumers to prove who they say they are online.
Right.
And,
Yeah, as I understand, there are proposals to build on the Real ID system that is being implemented and tying it to the iPhone or their phones, and as a way to ensure the identity of an individual that would help to prevent fraud. It would help to prevent, and it would also increase security for an individual.
yeah. And is this something that FinCEN would have specific recommendations on how to proceed?
I'd be happy to ask. I'm sure my colleagues at FinCEN would be happy to follow up with this.
Thank you. I think this is one of the really positive ways that this committee can get involved in crypto asset regulation generally. Thank you, and I yield back.
Thank you very much. The gentleman from Minnesota, Mr. Emmer, is now recognized for 5 minutes.
Thank you, Chairwoman Waters. And thank you, Mrs. Lang, for your testimony and your time today. I'm going to try to be efficient with my time, so I'd appreciate as concise responses as you could provide to my questions. Currently, stablecoins represent just 5% of the digital asset industry's total value. It's a relatively small fraction, but stablecoins are facilitating more than 75% of trading in the entire digital asset ecosystem. Quite significant. Clearly, stablecoins offer economic benefits that cannot be ignored. Stablecoin transfers have nearly instant settlement, and settlement can be confirmed by both parties on a public blockchain. These characteristics lead many to view stablecoins as less risky than the heavily regulated payment rails of our current banking system. Yet the President's Working Group report on stablecoins focused almost solely on their perceived risks. The report doesn't even provide a definition for stablecoin, but it doesn't hesitate to assert that the risks of stablecoins are so broad and cross jurisdictional lines that only insured depository institutions or banks should be allowed to issue them. As you mentioned, my colleague, Mr. Huizinga, previously in this hearing, you believe stablecoins could be both a bank-like product as well as an investment-like product, which is why you believe they should only be issued by banks. I firmly contend that a stablecoin is a payment instrument and is a fundamentally different asset than an investment product. If we base the evaluation of this report and this hearing today on a narrowly tailored definition of stablecoin, I think we might come to see that a bank-like regulatory framework would improperly regulate the asset class and inadvertently capture potential future financial products that are vastly different than what you and I think of as a stablecoin. For instance, under this report, a tokenized money market fund, which clearly would be a security, could fall under the same stablecoin umbrella as a fiat-backed payment token that is fully redeemable for cash. How is it that such vastly different financial products could be both defined as stablecoins, and the only institutional players that would be able to offer these vastly different products are banks? The reason I elevate this concern is because legislating and regulating in this space should not be done under such broad definitional scope, and doing so would severely limit future market growth. It's not unlikely that tokenized money market funds backed by government debt or commercial paper might seek to come to market in the future. These potential future financial products could ostensibly lower the costs of participation in the asset class while offering conservative returns to investors. Ms. Liang, do you think the same run risks and prudential risks would attach to stablecoins backed purely by U.S. government debt or highly rated commercial paper?
I believe you're raising some important issues about how quickly the technology is evolving and what the future of digital assets will be. That should
Actually, no, that was a very specific question. How about this? Do you think U.S. government debt that underpins U.S. government money market funds is risky?
There is no credit risk. There can be convertibility risks if
So they are risky or they aren't?
there's no credit risk,
Okay, so then.
but there can be liquidity risk just in the being able to execute the transaction.
Time I have left, Mrs. Liang, I want to thank you. Tokenized money market funds backed by government debt or highly rated commercial paper clearly would not impose prudential risks significant enough to reserve the issuance of all tokenized money market funds to banks. This is important to highlight because there is a void in the market between stable coins and security tokens. And a tokenized money market fund could provide an attractive, low-cost financial product with conservative returns. For this reason, I'm working on a nonpartisan legislation that would allow tokenized money market funds to come to market. Here's the bottom line. Banks should not be the only institutions in the ecosystem with dibs to issue the potential array of financial products that the President's Working Group report simply lumps together and ties as a stable coin. Thank you. I yield back the remainder of my time.
Thank you very much. The gentlewoman from Ohio, Mrs. Beatty, who is also the chair of the Subcommittee on Diversity and Inclusion, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you for holding this hearing. And also, Madam Undersecretary Liang, thank you for being our witness today. You know, as I've listened to both sides of the aisle today, this has been very eye-opening and interesting to me. In full disclosure, at one time, I probably thought this was more like the Wild Wild West of what we're doing. And now I realize that it is the future frontier. And while I don't want to overregulate to the point that it chokes off innovation, I do believe that some well thought out regulation would provide some legitimacy to this space and allow it to further flourish. Now, earlier in your testimony, Madam Undersecretary, you talked about the largest stable coin. Were you making reference to Tether?
That is the largest stablecoin.
Okay, recently they settled lawsuits with, I believe it was the state of New York and the CFTC for lying about the state of reserves that backs its currency. And further, they claim that about $30 billion of its holdings are invested in commercial paper, making them the 7th largest holder of such debt. And this is coming from an article in Bloomberg. So I guess what I want to ask you, how, Ms. Liang, how important is it that stablecoin issuers are transparent? And everybody knows, whether we're talking about this or diversity and inclusion, that I'm a big believer that transparency is a must. So that issuers are transparent with their reserves, and these reserves are audited by United States, let me repeat that, United States accredited firms, not Cayman Island firms.
Right. So transparency, I believe, is important, but it alone is not sufficient to prevent runs. So, for example, on money market funds, the holdings are transparent, but we've had runs onto money market funds when the assets backing those funds are other than government securities. So when the holdings are treasury securities and corporate, high quality, in stress, investors may still run. And we saw that in 2008, and we saw that in 2020. So transparency itself is extremely helpful, but is not sufficient to address the issues of investor runs.
Okay, so that's because of time. We'll come back to that later. Maybe I can talk to some of your team. Let me ask you this. What do you believe are the consequences for financial stability when so few hold such a large percentage of these different types of tokens?
I think currently the risk to financial stability, the systemic risks, are not high. They are growing, they are emerging. One issue in the broader digital asset space is the high price volatility. And as mentioned earlier, if that were fueled in part by leverage, or it's when prices fell, it would have impacts on the traditional
Okay.
financial system.
I'm only rushing because the clock
Large
is
systemic
ticking.
risk.
Let me go to something else. Congressman Meeks talked about minority communities and different communities. I've also been advised, in full disclosure, I thought this only applied to the top 1 or 2% of wealth, but now I'm hearing that Black and brown communities who are under and unbanked are also playing in this space. What's the risks for them, or how if I'm underbanked or unbanked, can I put myself in something that we don't really have regulations for now? Quickly, because the clock is ticking.
Yeah, so here I'd like to distinguish again between digital assets and stable coins. And stable coins has the potential to improve payments, make them cheaper, make them faster, and we're seeing potential benefits for cross-border. Digital assets, those that are not backed by, say, a pool of reserve assets and whose volatility, the prices are highly volatile, investors really need to understand the risks when they make those investments. Those, there are potential losses. High volatility stocks are not for all investors.
So should we be advising people to wait? That's a yes or no.
To wait to, I think we would advise investors and consumers that they should be aware of the risks of any assets that they are purchasing for investment purposes.
Okay, thank you. My time is up. Thank you so much.
Thank you very much. The gentleman from Georgia, Mr. Laudermilk, is now recognized for 5 minutes.
Well, thank you, Madam Chair. Thank you for having this this hearing today. And one thing I've seen over my years on this earth and the time I've spent in government is the hesitancy of some people to adopt new technologies, especially when it comes to government. And I'm not one to run out and just haphazardly accept anything that's new technology just because it's new. But I think it's very important for us to weigh the benefits and the other issues with any type of technology. My mind goes back to the early 1900s when the Washington Post ran an article when the word came out that these 2 bicycle mechanics, the Wright brothers, were testing a controlled flight device called an airplane. And the article said men will not be able to fly and should never be able to fly. It's because their hesitancy to adopt new technologies. However, when it comes to people in our positions, it's important that we have an honest weighing of the cost and the risks and the benefits of new technologies. And like Mr. Emmer had expressed, I'm a little concerned that and disappointed at how one-sided this report really seems to be for us to make a good decision. Most of it focuses on the risk of stablecoins, which obviously there are some, but there's little discussion of the benefits. In fact, the report mentions risk 131 times, but only mentions benefits 2 times. So I wish the report was more balanced, and I hope this administration will be more ready to embrace some innovation, not just accept everything, but actually give an honest look at innovation and technology and not try to stifle it. The report also doesn't address the regulatory frameworks that many states have already established for digital assets. Banking regulators in a number of states supervise stablecoin issuers under money transmittal laws. A question, Ms. Lang. The report calls for Congress to establish a federal regulatory structure for stablecoins. As part of that, does the administration intend to account for the regulatory frameworks that many states have already established for digital assets to avoid creating redundant requirements?
So the PWG report recommends a framework that is reduces inconsistency and reduces the fragmentation of current regulations and builds on the state current framework. It can build on the state money transmitter laws. Insured depository institutions can be federally chartered or state chartered. The goal of the framework was to provide some consistency, which we believe actually is beneficial to innovation. That having state laws apply, which vary and increase the complexity of addressing lots of different regulations is a hindrance to innovation.
So what you're looking at doing, if make sure I understand this, is considering state laws, but you want to avoid having contradictory state laws. Is that to where that one state may have one regulation, another regulation? Or are you looking at what I'm understanding you're saying is you are considering existing state regulations?
Yes, it would build on existing state frameworks. As I mentioned, insured depository institutions can be state chartered or federally chartered. State money transmitter laws, as someone mentioned, they're at the state level. There is no federal money transmitter license. So this was an approach to try to reduce some of the fragmentation in the system with an approach that we believe can be flexible and does not use the entire set of rules that apply to traditional banks, and they could be adapted to stablecoin issuers.
Well, I think that is important, not have fragmentation or conflicting regulations, but also I think it's important to avoid one size fits all regulations specifically. We should not be broadly applying banking regulations to stable coins. So does the administration intend to account for the significant differences between depository institutions and stablecoin issuers in its regulatory approaches? Am I understanding that?
Yes, that is our understanding, that the banking regulators have flexibility to adjust the supervision and regulation that would account for differences between stablecoin issuers and banks that also make loans. So it would be a different approach.
Thank you. And Madam Chair, I yield back the balance of my time.
Thank you very much. The gentleman from California, Mr. Vargas, is now recognized for 5 minutes.
Thank you very much, Madam Chair. I want to thank you for holding this hearing, and also the ranking member. It's been very fascinating, and especially Madam Secretary, I appreciate the time you've spent with us. I do think that stablecoin and cryptocurrency has some potential advantages. Certainly when we take a look at remittances, remittances are very important in my district, and frankly, I think a benefit to Latin America and our hemisphere. And I think that there's a real possibility. But I also think that there's real potential risks here. Just listening to the previous speaker here, he said that this administration should be more balanced when it comes to cryptocurrency and digital assets. Are you familiar with what President Trump said about Bitcoin?
I am not. I am not.
Well, let me tell you what he said, since you're not familiar with it. Here's his balance of the previous administration. Bitcoin, it just seems like a scam. I don't like it because it's another currency competing with the dollar. Hardly seems balanced there. But anyway, I just throw that out there because certainly the last administration had a particular point of view, certainly the president. So when you get accused of not being balanced, I don't think that's correct. But anyway, I appreciate all the work that you've done on this. But I do have concerns. I mean, I also heard that this is new technology and it's new stuff that we've never seen before. The reality is that before the Civil War, banks used to issue their own paper, and they were redeemable for either silver or gold. And what you would see is that many of these banks, unfortunately, would issue more paper that was not redeemable, and then you'd have a run and you'd have all sorts of chaos. That's why we had the Banking Act of, I think, like 63, the National Bank Act, to make sure that we had the dollar and that the dollar was backed by the full credit and also gold at the time of the United States of America. So it's not the notion that we've never had this before, that you haven't had people issuing coins. I mean, the reality is we've had that. It didn't work out very well. Now we have new technologies, and that's why we have to be open-minded. I certainly am. But I do have concerns about the, and I'll read here from it's page 2 of our report, and it says, while stablecoins have the potential to address shortcomings of the existing payment system, such as the potential for lower cost and real-time payments, they pose legal, regulatory, and oversight challenges and may present risk to monetary policy. I do think risks associated there. Now, we've been saying how small stablecoin is. I remember when we were saying how small cryptocurrency was. We used to talk about it in the billions. Now we talk about it in the trillions. Could you talk a little bit about that risk?
Yes, sure. So one of the risks that we focused on was something we would call concentration of economic power. And that is because stablecoins as a payment mechanism could scale up very quickly. One could imagine that you would create a closed loop, almost a private system of money, similar to what you were referring to in the late 1800s. That kind of risk is something that we think Congress should consider. The proposal in the PWG report, one possible path on that is to have supervisors require interoperability so that there'd be greater competition among stablecoins and the less potential for one system. That then also would reduce interference with implementation of monetary policy, as you mentioned, that you have an alternative money system. So that is the third prudential risk that we identified in the report.
Would some of these things be corrected if you did have the central bank digital coin? I mean, it seems to me that you would then have a possible solution there with the CBDC.
Yeah, so CBDC, that possibility, I think, as I mentioned, will depend quite a bit on the kinds of features the CBDC would offer. It could be very different. The current situation, however, is CBDC is still being investigated by many central banks, including the US. It could be years before it were introduced if they made the decision to introduce it. And stable coins are here today and they're growing quickly. So and it leaves regulators in an uncomfortable position to say we should wait until there are decisions about CBDC.
Thank you.
Thank you. The gentleman from West Virginia, Mr. Mooney, is now recognized for 5 minutes.
Thank you, Madam Chair. The growing popularity of stablecoins introduces some regulatory challenges, but also presents opportunities. At a time when some regimes, like take, for example, communist China, are using top-down restrictions on their digital yuan to maintain totalitarian control of their populace, stablecoins have emerged as an innovative entrepreneurial way to provide wider access to the US dollar around the world. Stablecoins pegged to the US dollar can help ease cross-border transactions and help maintain the dollar's status as the world's reserve currency. So Ms. Liang, in your testimony, you mentioned furthering the United States' continued leadership of the global financial system as a goal of the President's Working Group framework. Can you explain how the Presidential Working Group's recommendations aim to further America's global leadership on the world stage?
So I think first, the role of the dollar and the role of the US and the global financial system depend primarily on the country's governance structure, its respect for rule of law, the strength of its institutions, the strength of its economy, the liquidity of its financial markets. Technology can play a role. It is not the primary role. And I believe that stable coins that are tied to the value of a US dollar can help to promote the role of the US dollar, but it needs to be on a stable footing. It needs to actually be stable. Stable coins that are not stable could undermine some of the confidence in a dollar.
All right, well, thank you. I want to ensure that any regulation we provide of stablecoins does not get in the way of one of our country's greatest strengths here in America, which is innovation. With global adversaries like China, which have banned cryptocurrencies and the freedom they represent, our country can embrace them. And next, I'd like to pivot to the role of Congress in this process. The report calls for congressional action on stablecoins, but also says that FSOC should act on its own to regulate stablecoins in the absence of legislation. So Ms. Lang, do you have a specific timeline in mind for congressional action before the FSOC would step in on its own?
So as you mentioned, the recommendation is for legislation. The Financial Stability Oversight Council has a responsibility to be monitoring for risks to financial stability and to consider actions to reduce those risks. I think so it's an ongoing monitoring of the issues. They have some tools, but they are not a substitute for legislation. They cannot make structural changes to what stablecoin issuers would be. Any action they would take is a little premature given how quickly the system changes. I'm sure that their processes are defined by what is laid out in the Dodd-Frank Act, and it would be very data-driven and very deliberate and would invite public input and be transparent.
All right, just to follow up and make a finer point on it, let's say, for example, this year that those stablecoin legislation makes it through Congress by the end of the year. How do you think Treasury would respond to that?
I think, again, the council would be monitoring risks to financial stability to the extent that any risks to financial stability were increasing. That it would be their responsibility to consider what tools it has to address those risks. But it is not a substitute for legislation.
All right, in my last 30 seconds, let me just say, well, thank you. And I do fear that hasty action on part of regulators could do more harm than good. Sometimes people have the best of intentions, but it has an opposite effect. The last thing we need is a rushed regulatory process. Congress, where we're elected to serve, is a deliberative body, and the legislative process does take time. I'd say let Congress do its work, let this committee do its work. This is a complex issue. It's more important to get it right than to rush and get something done quickly. So thank you, Madam Chair. I yield back.
You're welcome. The gentleman from New Jersey, Mr. Gottheimer, who is also the Vice Chair of the Subcommittee on National Security, International Development, and Monetary Policy, is now recognized for 5 minutes.
Thank you, Madam Chairwoman, for holding this important hearing and discussion on new innovations in the stablecoin space. Given the explosive growth in the cryptocurrency, the stablecoin and cryptocurrency space, including, as I said, stablecoins, which continue to be front and center as an issue, it's critical, I believe, that Congress examine how best to establish appropriate guardrails around stablecoins to ensure these assets continue to mature here within the United States instead of fleeing overseas. I'm continuing to work on draft legislation examining how best to establish guidelines on stablecoins, including coins issued by insured depository institutions, but also through properly constituted non-bank stablecoin issuers. Establishing appropriate guardrails to mitigate the risk of a run and potential collapse of a stablecoin issuer should be a primary goal of any stablecoin legislation, and I look forward to working with my colleagues on both sides of the aisle on this issue. Ms. Lang, if I can start with you, it is great to see you again, and thank you for coming today to testify. If I can ask you a question, if Congress looks at stablecoins in a partisan lens and in turn fails to pass meaningful reform in short order, do you believe we could see the collapse of an improperly backed issuer? And what would the effect be on the broader cryptocurrency market as well as ordinary people investing in this market?
I do believe that if stablecoins continue to increase rapidly and there is large stablecoins without appropriate reserve assets backing the ability for investors to redeem, that is a potential run risk and could have implications for other short-term funding markets and systemic risks for the financial system.
I agree. I'm very concerned that if we sit here and let partisan games get in the way of getting a bill done, that would be a huge mistake. And obviously, we'll continue to lose companies overseas, and they will flee our markets, and consumers will be hurt. As part of the PWG report, you outline how stablecoins can pose substantial illicit finance risks without appropriate oversight. The report specifically cites the need to counter terrorist financing as a major objective of stablecoin oversight. Additionally, crypto scams resulted in $14 billion in losses in 2021, and I've heard from some of my own constituents who have seen funds stolen. The hard-earned dollars of ordinary citizens could literally have been stolen to help finance terrorist attacks. Do you think the only appropriate oversight method for stablecoins would be to ensure all issuers are subject to bank-like AML KYC requirements to counter terrorist financing and scams?
Currently, stablecoin issuers are subject to the AML, CFT regulations, the anti-money laundering, that under the state money transmitter licenses. So that triggers that they have an anti-money laundering framework. It triggers various reporting requirements of large transactions or suspicious activities. The banking charter could increase some of those compliance regulations, but I do think that FinCEN has a framework in place that, as I understand it, some of the bigger issues with illicit finance now is inadequate enforcement of existing regulations in other countries. And Treasury is leading an effort at FATF to try to improve compliance and enforcement of these actions in other countries and the exchanges in those countries.
But there's some potential holes right now. We have to make sure we close them, right?
I think that's correct. That is correct.
When examining privately issued stablecoins, I think a major concern is ensuring we don't allow these coins to undermine the supremacy of the US dollar. The PWG report advocates for an approach where stablecoins could be issued by insured depository institutions. Actually, the report says, quote, if well-designed and appropriately regulated, stablecoins could support faster, more efficient, and more inclusive payment options. Would you mind elaborating a little bit on that, please?
As I mentioned, I think the potential for stablecoins to improve the speed and efficiency of payments is large. We're seeing, payments being offered 24/7, instantaneous, on public blockchain ledgers, on public blockchain. So that has a benefit to help all consumers by reducing the cost of payments and increasing their speed. We're seeing that being tested in cross-border remittances. We're seeing consumers respond to surveys to say they would benefit and they would like to use stablecoins. So I think that when that becomes used to conduct transactions in a system that we all share, a payment system, it's important that that payment system be operationally resilient to all kinds of stresses. And that is the basis for the recommendations of the PWG.
Thank you so much. I yield back.
Thank you. The committee will take a break for 5 minutes. The gentleman from Ohio, Mr. Davidson, is now recognized for 5 minutes.
Thank you, Madam Chairwoman, and thank you, Mrs. Lang, Ms. Lang, for the testimony today and the work that you've been doing on this topic. Yeah, I'd like to step back and discuss the concept of a stable coin more broadly. I think it's easy to get caught up in discussing this topic solely in the context of digital assets that are pegged to currency or to a commodity. The President's Working Group report acknowledges that some stablecoin arrangements could fall under U.S. security laws, which is the SEC's jurisdiction. This risks a siloed approach to addressing specific types of stablecoins. In fact, footnote 2 of the report explicitly states that the report, quote, does not provide recommendations regarding issues or risks under federal securities laws or under the Commodity Exchange Act. This gap, to me, is concerning. So my question is this: if you think about stablecoins, you've referred to them as risky, as potentially systemically risky, but you haven't really talked about specific things. I guess we did briefly allude to Tether, which I've called a time bomb. It's not regulated. It's not getting a lot of scrutiny. And I think the Securities Exchange Commission would wisely focus some attention on Tether. But if you look at the next largest stable coin, the US dollar coin, it's a highly regulated asset. Do you believe that the New York financial services regulatory framework is a deficient means of providing regulatory clarity for things regulated as New York trusts? In fact, we're talking about stablecoins as this new or emerging idea, but there've been stablecoins approved under New York trust laws since 2015. We're 7 years late. Could you address the regulatory framework of New York specifically, and those coins that are audited, have audited financials, and transparency requirements under New York law, as just one example, to be specific?
Yes. So thank you for that question, Congressman Davidson. I think the issue of stablecoin is that the PWG report focused on is that it can serve as an investment, and SEC and CFTC laws and regulations would apply. But it also, as serving as a payment instrument, makes it unique to what distinguishes it from, say, a money market fund. The New York state laws apply to stable coins as a investment and look to audit the assets or provide some transparency around the assets, but does not have the authority to look into the other functions of a stablecoin that are necessary for it to function as a payment.
Okay, thank you. Thank you for that. So if you look at it, it's like, okay, as a payment system, you know, Visa and MasterCard aren't legal tender, but frankly, they're about the only thing that's accepted in America. Cash, it's almost impossible to pay in cash. And that's actually the legal tender currency of the United States. We've made it almost impossible to transact that way. And that's made it so that there's an emerging technology for better payment systems. And frankly, digital assets aren't subject to the Durbin Amendment. So the market's working. They're more affordable, lower cost transaction processes. And as an investment, stable coins aren't really generally good investments. They're worth $1. So why would you own them? And so the question is, if we think about, you know, dollars, like US dollar coin is US dollars and treasuries. Another one would be gold. We've talked about silver notes. You know, one of the first ones approved was a New York Trust regulated stable coin for gold. But there are also stable coins that are pegged to other very liquid assets, like, say, shares of Apple. So if somebody has custody of shares of Apple, you know, some would say, and make this choice clearly every day in our financial markets, the best in the world, and say, I'd rather hold shares of Apple than cash, because I don't think my cash is going to keep up with inflation. And I do believe that Apple is going to become more valuable over time. That's an investment. They could tokenize that, and the share would the token would be represented by someone who truly had custody of shares of Apple, as an example. Right now, that's not possible for American citizens, but it is for others around the world. Wouldn't that also be a stable coin?
I think the value of the stable coin is distinct because the value is designed to be stable and close to $1. The value of Apple stock, you could use it to transact, but it is volatile. And so both the merchant and the consumer.
It's volatile in terms of US dollars, but less volatile than it's done better to keep up with inflation than US dollars. It's outperformed inflation as an example. So the US dollar isn't a good metric. Frankly, the stable coin should be stable relative to what it holds. And I don't think that this working group does anything except protect the big banks. It may as well be called a big bank protection concept. So, my time has expired, and I wish we could go a lot longer on the topic. Thank you.
The gentleman from Florida, Mr. Lawson, is now recognized for 5 minutes.
Thank you, Madam Chair, for having this meeting to you and Congressman Henry. It's a great opportunity for us to learn more and more about what is going on in the economy. Secretary Lane, according to the recent NASDAQ article, data shows that Black and Latino communities are driving national mainstream adoption. The article highlights a Harvard-Harris poll note that whites only 11% of the only 11% of the whites of American report owning cryptos. 23% of Black America and 17% of Hispanic America own such assets. This is a positive trend, but it also signals a greater need for financial literacy and skill training. The rising interest is new technology instrumental and opportunity to prepare key demographics for the next gen workforce. How do you suggest the federal government be more proactive when it comes to the future of work strategies to position historically disadvantaged groups to compete in the global innovation economy and foster digital equity?
Thank you for that question. That actually gives me an opportunity to highlight an initiative, a new initiative at Treasury through the Financial Literacy and Education Council. We announced a new initiative on digital assets just within the last month or two. We think there is a need and an opportunity to introduce digital assets, highlight the risks and the opportunities, highlight the distinctions between types of digital assets. This is a cross-government council, has been around for many years, and digital assets is a new initiative. In addition to that, which is the education component, the Consumer Financial Protection Bureau is clearly following and tracking and taking actions against misleading advertising. And the market regulators will, of course, be looking to impose, take actions to reduce fraud and take other actions to protect investors.
Okay, thank you. And Madam Secretary, financial regulator experts have stated that an effective payment settlement system requires 4 things: lower fees, predictability, exchangeability for goods and services, and consistent high speed. Present, there is a consensus among most experts that stablecoins do not meet all of these objectives. Compared to our traditional financial system, would you still consider stablecoins to be an effective way to settle payments?
Mm-hmm. So the stablecoins have developed very quickly. They are continuing to develop. There's an incentive for developers to make them very efficient, to manage all these, to meet all these requirements to be an efficient payment. Are they there yet? That's hard to tell. They haven't been tested in periods of stress. I think there still needs to be more oversight of their operational risks, their convertibility risks to function as payments. But I think the potential for them to be beneficial to the payment system, to cut costs, to make it faster, to offer 24/7 is absolutely there.
Okay, Madam Chair, I'm gonna try to get in. Do you think it's necessary for stable coin issuers to meet the same capital requirement of traditional IDIs if the majority of the reserve assets are backed by cash?
I believe in terms of capital requirements, risk-based capital requirements would clearly be lower for if stablecoin issuers held only high-quality liquid assets.
With that, Madam Chair, I yield back.
Thank you. The gentleman from North Carolina, Mr. Budd, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Ms. Lang, for being here. The President's Working Group reports, it states that absent urgently needed legislation, the respective agencies in the FSOC can apply their existing authorities. So do you see a scenario where they get tired of waiting for Congress to act, and in turn they would place SIPI designations on particular stablecoins?
I think the scenario for the council to take such actions is premature to understand how it could apply its tools. The council has a responsibility to monitor risks to financial stability. It has been following and monitoring digital assets. But FSOC's tools are limited. Designation is limited. It is not a substitution for a requirement that stablecoin issuers be insured depository institutions.
If I'm hearing you correctly, that's
their authorities in the future would have to be very fact-driven and deliberate.
so. If I hear you correctly, you don't see a scenario where FSOC would front-run Congress and then place heavy limitations on stablecoins.
In the current environment, I don't see that FSOC would take such actions.
Okay. So second question, in his confirmation hearing last month before the Senate Banking Committee, Fed Chairman Powell agreed that well-regulated, privately issued stablecoins can coexist along a Fed-issued CBDC. So do you and the Treasury Department share the same opinions, Chairman Powell, or do you differ from that?
No, absolutely agree with that assessment. I think regulation of stablecoins will make them more stable, but does not preclude at all the introduction of a CBDC, nor does it determine the features of the CBDC will probably be the ones that determine how stablecoins exist or coexist.
Okay, thank you. So there seems to be some disagreement among regulators about whether or not stablecoins are securities, which would determine if they fall under the SEC's regulatory regime. My view is that stablecoins that are backed by quality assets do not meet the Howey test. So do you believe that stablecoins should be treated as securities?
So I would really need to defer to the SEC or the CFTC for their views on the applicability of their laws and regulations. I think that this is a product that has features of a number of different financial products and services. And as such, that is why the regulatory approach to it should meet those differences.
Very good. I thank you for your time, and Chairwoman, I yield back.
Thank you. Thank you very much. The gentleman from New York, Mr. Torres, is now recognized for 5 minutes.
Thank you, Madam Chair. Undersecretary, do you believe, as I do, that 100% of stablecoin reserves should consist of cash and cash equivalents? In the interest of time, a simple yes or no will suffice.
Yes.
And I share the PWG's concern that stablecoin, if left unregulated or poorly reserved, could pose a systemic risk as it becomes more widely adopted as a means of payment. But here's where we disagree. The risk of stablecoin, to me, is best managed not by the blunt instrument of banking regulation, but by common sense rules requiring transparency and accountability, reporting and auditing, liquidity standards and redemption rights, rules that can be passed on a bipartisan basis, the benefit of stablecoin, simply, safely, and soundly regulated, will ultimately outweigh the risk. And for me, the tokenization of the dollar, the ability of the dollar to move at the speed of the blockchain, has the potential to lead to a better, cheaper, and faster payment system. Now, the leading stablecoin issuers in the world have chosen to peg their stablecoins to the US dollar, which to me represents a reinvigoration of the dollar as the world's reserve currency. Undersecretary, do you believe, as I do, that dollar stablecoins have a role to play in preserving the primacy of the US dollar?
I do believe that, yes.
During a House Financial Services hearing in December of 2021, Brian Brooks testified that Circle, the stablecoin issuer of USD Coin, had applied for a bank charter with OCC, but was unlikely to receive one. Undersecretary, should OCC grant a banking charter to Circle?
I'm not in a position to understand a particular application. The PWG recommendation is for an issuer to become an insured depository institution with the appropriate regulation that matches the activities. So that would be the recommendation, but I cannot comment on a particular application.
I'll just note, the PWG, as you noted, has taken the position that stablecoin issuers should operate within the regulated banking system. If that is indeed the policy preference of the PWG, it seems contradictory to deny a stablecoin issuer the ability to operate within the regulated banking system. I have a question about the notion of regulating stablecoin issuers as banks. Suppose for a moment there's a stablecoin issuer whose reserves are verifiably backed by the dollar on a one-to-one basis, and whose reserves can be immediately redeemed for a dollar on a one-to-one basis. If the stablecoin issuer has no fractionalization of reserves and has no lending, it would seem to me that the stablecoin issuer is operating differently from a bank and therefore should be regulated differently from a bank. Undersecretary, even though the PWG proposes regulating stablecoin issuers as banks, do you acknowledge at some level that the absence of fractionalization and the absence of lending are relevant factors that differentiate stablecoin issuance from banking and therefore should differentiate stablecoin regulation from banking regulation?
I absolutely acknowledge that there are differences, and the lack of lending makes a stablecoin issuer different from a traditional commercial bank. The proposal recognizes or relies on the flexibility of current banking regulation to distinguish between those kinds of activities. That an stablecoin issuer that does not make loans would not be subject to regulations that would apply to institutions that make loans. The distinction about the stablecoin issuer is that it's more than just the redemption and creation of stablecoins, which the transparency and disclosure rules could apply to, but it's also about storing, transferring, using the stablecoin for payments. And that is
in the interest of time, I just want to interject. The reserves of Tether, the largest stablecoin issuer, consist heavily of commercial paper shrouded in secrecy. The public has a right to know the names of the companies behind the commercial paper and the countries in which those companies are located in order to fully assess the true safety of Tether's reserve assets. Suppose for a moment we were to adopt a rule requiring reserves that are 100% cash or cash equivalent. Since Tether has become one of the largest holders of commercial paper in the world, what unintended effects could a 100% cash or cash equivalent rule have on the commercial paper market?
So I believe this is similar to the issues that arise in the money market fund regulation. There are government money market funds and there are prime money market funds. The prime money market funds under new regulations have reduced their holdings of commercial paper, and commercial paper issuers have sought other investors. I think over time, the markets and the issuers find the right investors and reduce risk to the system overall.
My time has expired. Thank you.
Thank you very much. The gentleman from Tennessee, Mr. Kustoff, is now recognized for 5 minutes.
Thank you, Madam Chair. Thank you. And thank you to you and to the ranking member for calling today's hearing. And Undersecretary Ling, thank you very much for sitting now for almost 3 hours. Frankly, I appreciate your straightforwardness in talking about issues that are complex to probably a lot of people. And to that point, if we could, the President's Working Group report that talked about the uses and the benefits of stable coins. I know you've touched on this and we've gotten in the weeds during today's hearing. If you were talking to any one of our Rotary clubs or Kiwanis clubs anywhere in the country, could you talk at that to that degree, or if you were talking to one of those groups about the uses and the benefits of stable coins?
Mhm. So I think stable coins reflect a new technology, and the technology itself can be complicated. But what it does offer is the ability to transact payments instantaneously, 24/7, on a public chain so that the transactions are immutable. So I think it offers efficiency, makes the payments cheaper, faster to meet consumers' needs. And the technology is sort of behind that, but I think that's what the benefits are. How that technology can evolve and introduce other innovations is sort of open at this point. This is just every adaptation, adoption and further adaptation, I'm sure will come. So I think that's what the explanation of stablecoin is. It's an alternative form of cash, an alternative way to make a payment.
So you mentioned the technology, which I appreciate. And I know we're talking in theory, but it would be a true statement that if we were too heavy-handed from a regulatory standpoint as it relates to the technology, then it doesn't catch up.
Mm-hmm.
Is that fair?
I agree. I think it's a balance that needs to be. There are benefits and there are costs. Yes.
Right. I mean, it's not easy to find that balance, and obviously you've been questioned today by members who have different thoughts about the degree of regulation, which is fair, and that's why we're here, and that's why we appreciate you participating in today's hearing. If I could, and I know there have been some questions to you related to the CCP. We have seen recently the CCP go after some digital assets, outright ban on some of those assets in China. Can you talk about the consequences, if you will, of China's crackdown on digital assets, and maybe what lessons we can learn in the United States from those crackdowns?
Mm-hmm. So I believe, as I understand, China introducing the ECNY, the digital yuan, is in some parts a way to take back some control that they had lost to private firms that offered digital assets. And they're offering their own digital currency, a CBDC, which will offer a lot of lessons for other countries. In terms of adoption, they are offering incentives. As we understand it, people are still evaluating whether to use the ECNY or the other two products that they had become accustomed to. I think it's reflecting that there's a change in technology for how payments will work, and consumers will make choices. And they are moving into this market. China doesn't value privacy as much as, say, the US does. So I think the lessons from how they introduce theirs versus how the US could introduce one here. In that space are a little less direct, but I think the provision of CBDC, the introduction of custodial wallets by the Central Bank of China will have a lot of lessons for other countries as they consider how to introduce a CBDC if they choose to do so.
Thank you.
Thank you, Secretary. Thank you, Madam Chair.
Welcome the gentleman from Massachusetts, Mr. Lynch, who is also the chair of the Task Force on Financial Technology, is now recognized for 5 minutes.
Thank you, Madam Chair. And Undersecretary Liang, thank you for your willingness to come before the committee to help us with our work. This has been a very good hearing. We're currently in a period of elevated inflation, and the Fed has made announcements that over the coming months and perhaps into next year, they'll introduce a series of interest rate increases in order to try to get control of that inflation by increasing the cost of money. And my concern is that monetary policy, that ability to control the cost of money would be undermined by, let's say, if Meta, formerly known as Facebook, they had an idea about a digital currency, and they have that network effect where they've got 2 billion daily users or something like that. Wouldn't that wouldn't the introduction of stable coins on a wider basis undermine the Federal Reserve's ability to control inflation, for example?
I think you're raising an important issue about private money increasing quickly in scale that could produce its own internal system, which is then outside what the central bank would set interest rates and control. I think that is exactly one of the concerns about large technology firms or large firms with networks that could create a closed loop. I think the implementation of monetary policy does come into play, the questions around how do you do that? I think that's an important issue. That was the prudential risk we raised.
Okay. Have you thought through how, in periods of high inflation, for example, the Fed could retain the ability to restrict, say, an issuance of a stable coin during that high inflation period? Is that something that might be a tool that would mitigate that danger, or am I getting into someone else's jurisdiction as opposed to Treasury?
Yeah, I think that probably starts to cross the line of separate independence of monetary policy from the regulatory structure of the financial institutions. But it's something that I am sure the central bank, the Fed, would be thinking about in terms of introducing a central bank digital currency and how it would coexist with private stablecoin issuers, and that they would be considering that seriously when they're in their efforts.
All right. Let me ask you this. I know a couple of members have raised this in the past, but it would seem to me that the issuance of a central bank digital currency by the Fed, and I know they're actually working with the Boston Fed is working with MIT in Boston to come up with the technology around that. Would not that diminish the value of many of these stable coins, especially with respect to the payment system? In other words, instantaneous transactions with near instantaneous reconciliation and closure, settlement, excuse me.
Yeah, so I think there are a lot of really important questions in terms of designing a CBDC, all of which would have implications for how they either coexist or compete with private stablecoins. There would be issues of who they held the accounts with, whether there would be caps on the accounts, whether they would be interoperable with private stablecoins. As you know, the Fed is looking at this, and in their paper, they raised 20-something questions around, which just suggests the complexity of the issues. And I think that's a critically important issue for the Fed and for Congress to consider what the future of the money and payment system should look like in this country.
Thank you, Madam Chair, and I yield back.
Thank you very much. The gentleman from Indiana, Mr. Hollingsworth, is now recognized for 5 minutes.
Well, good afternoon, everybody. I'm really excited about this hearing. I've been looking forward to it for quite a while. Undersecretary Lang, I have been on an emotional roller coaster over the last couple of weeks and through this hearing. I started off dismayed because I saw in the report put out that only banks should issue stable coins and they should be subject to prudential regulation. But then, surprisingly and happily, by the way, I've heard you a couple of times in response to some of my colleagues' questions maybe draw a little nuance to that particular issue. And I want to go back to a few things that you said earlier. Quote, the full set of bank regulations do not need to be applied to a stablecoin issuer that does only stablecoin issuance. There's flexibility in the insured depository institution framework, end quote. Next quote, stablecoin issuers that have a simple business model holding high quality assets would be subject to a less stringent supervision and regulation, end quote. I think these are really important points to make, that there is the opportunity for good stablecoin issuers, and I've met many stablecoin issuers that are very interesting, being good operators, good stewards, and good issuers, for them to have a lower regulatory model provided that they are wholly reserving for the issued assets. Can you talk a little bit about the type of assets that should qualify as high quality assets according to you?
Thank you for that. And those statements I made, I stand behind. The high quality assets that can meet the ability for investors or consumers to redeem their stablecoin should be cash, treasury securities. It could be, if it were in the banking system, reserves at the central bank, which are the highest quality, and then would also not have any convertibility issues on redemption. So that would be, I'm not trying to specify or limit what could be in that category, but just high quality credit risk-free assets.
And I think we would also want to make sure, not just high quality, right? 30-year treasuries are high quality, but we also want to make sure they're of a limited maturity, right? You've talked about run risk several times. Yes. Making sure that near-term maturity at par is important as well. Is that right?
I think that's an important absolutely important consideration, that short-term treasury bills convert much more quickly to cash than longer-term treasury securities. We found, at least in March of 2020.
Indeed. Well, and several times previous to that, and obviously you're taking less interest rate risk, shorter duration. So yes. I guess my point here today, and I think you've elucidated it very well, is that we do have the ability to say, if you are going to be, I'll use your word, a simple stablecoin issuer, and you're going to fully reserve, and your assets are going to meet a certain quality and are going to be no longer than a certain duration, we should accept that even without prudential regulation layered over and above that, right?
I think there are regulations related to the operational risks of stablecoin for storing and transferring the stablecoins as payments. that are more than just the consumer protection kinds of rules that the state money transmitter laws usually focus on?
Well, there are a lot of businesses that aren't subject to full prudential regulation that do those very things, though, right? I mean, we figured out custody of assets outside of banking alone and other issues related to, I'll call it the back end operations, that we could sufficiently ensure they operate without the full weight of prudential banking regulations, though, right? There are businesses that we allow to exist today.
Yeah, so the other service providers in the recommendation, those other service providers were not required to be, the recommendation was not to require them to be an insured depository institution. It only applied to the issuer of the stablecoin.
Right.
As you know, it's part of a broader arrangement for it to function.
In my 20 seconds, I just want to make sure I hit this nail on the head. I think there is room for non-bank stablecoin issuers, provided that their assets are backed wholly and that they are of sufficient quality and they don't exceed a certain maturity. I think that we should find another avenue for this technology to develop outside of giving the exclusive power to banks themselves.
Thank you very much. The gentleman's time has expired. The gentleman from Illinois, Mr. Caston, who is the Vice Chair of the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets, is now recognized for 5 minutes.
Thank you, Madam Chair. Thank you, Undersecretary Liang. I want to follow up on the conversation you had with Mr. Huizenga, and I think there's all these really, really cool things around digital money and all these things we're developing. I also think sometimes when we wrap things in acronyms and tech bro speak, we make the old sound new, and some of these things are simple. And I just want to just focus on sort of the simplicity of currency. Because if I understood your answer to Mr. Huizenga, and I hope you'll correct me if I got this wrong, when he asked you, why shouldn't we regulate this like money market mutual funds? You said, well, because that can't be used as a currency and this can. I see you nodding, so hopefully I've got that about right. It seems to me that can be used as a currency as one question is as a separate one. I mean, cowrie shells can be used as a currency. And as Mr. Sherman noted, there's an awful lot of people who are not taking stable coins or any digital currency as money right now. And to my simple way of thinking, that's not really that surprising. That if you want a dollar denominated currency, we've got one, it's the dollar. And we've created a world where the dollar is valuable as a currency, A, because we can pay our taxes with it, which is 20% of the economy roughly, and B, because it's backed by the full faith and credit of the government. So since presumably I didn't see anything in the PWG that said we want to allow people to pay taxes in stablecoin or Dogecoin or Ethereum or whatever else, then the full faith and credit piece of any dollar-backed stablecoin really comes down to making sure we've got the management and the reserve rules, such as we already have for money market mutual funds. So regardless of whether or not this actually becomes a currency that converts from can be used to is being used, is there any reason why we should not be saying, let's put all of those same fiscal protections that we have in money market mutual funds in these stablecoin markets?
So I believe that the protections of the money market fund industry that apply to money market funds would apply to stable coins to the extent that they offer a stable, redemption into a dollar. I guess I would think that stable coins, because they can be used as payments by households and businesses and are currently being adapted to do so, raises a separate set of issues. And that is what the PWG report tried
Okay,
to
well, and if I may, and I understand that you have to be a little bit careful about not recommending policy, but I understand that people are trying to do that. I think it's a separate question of until they do, how does this behave in the market? Because we do still need to have all those consumer protections that I think Mr. Himes eloquently outlined. So to the extent that this is being used as a currency today, where there's a push, if I understand your testimony and my understanding of the market's right, it's these three big values. Number one in remittances, number two in clearing time, and number three in lower fees and all the benefits that that creates. Did I understand your answer to Mr. Gottheimer correctly? That you think that those issues, that's not creating essentially an arbitrage issue with anti-money laundering and know your customer rules, that the rules around this are robust enough that we're just arbitraging away existing market inefficiency, not dodging regulations. Is that the gist of your answer to Mr. Gottheimer?
Yes, in terms of the illicit finance risks of stablecoins, yes, absolutely.
Okay, so then I get back to saying, okay, so if we think that eventually this thing is going to have appropriate regulation as it sits right now to make sure that there's the fiscal protections and the no break the buck of the money market fund. And if we agree that the existing rules, and I don't know that I'm convinced on this, but if I take your testimony, that we agree that the existing rules provide all the AML, know your customer protections, why go through all the complexity of creating a stable coin that exposes us to those risks that we have to regulate around to protect? Aren't we just really creating a central bank digital currency that would solve those issues just as well and not have all of these other exposures? Like what is a well-regulated stablecoin providing that a CBDC doesn't?
I think one, the backing of a central bank digital currency would be the back by the central bank. This is by high quality assets, which are not central bank reserves. So there is that distinction. The other distinction that I think that we were trying to grapple with is that there are private stable coins now, and they are growing and growing quickly and may grow faster if network effects allow them to scale up. And there is not a central bank digital currency being issued right now. So this could be the substitute. It could be a complement. They could go away once a central bank digital currency were to be introduced, if it were. But the situation is they are currently being used. And
okay, so the chair is telling me we're out of time, I know, so thank you, we could continue. I just want to, and I'm all for private sector innovation. I just want to make sure that if that requires us to build a big regulatory framework, let's have eyes wide open about what that means.
Thank you very much, Mr. Castro. Gentleman from Ohio, Mr. Gonzalez is now recognized for 5 minutes.
Thank you, Madam Chair. Thank you for holding this hearing. Thank you, Undersecretary, for your participation. I'll start with the question that I think Mr. Caston just left with, which is what do we get with a well-regulated stablecoin that we do not get with a central bank digital currency? I think privacy for one, right? So there's a question, a design question with the CBDC. But me personally, I have massive privacy concerns that I don't see a CBDC being able to address. And secondly, the innovation that we get on the private sector. The history on this is pretty clean. I think that private sector innovation tends to be more efficient, more economical, and better. And so I think those two things are worth considering. Ms. Liang, I want to start with a question with respect to where the primary prudential oversight of stablecoins should exist. There are some proposals that have been put out that would put that under the Treasury. My view is that's an odd fit. I'd like you to opine on that. And maybe if you're willing, where do you think primary prudential regulation should be housed within the federal government?
Mm-hmm. So thank you. So I agree with you on the central bank digital currency, that privacy and innovation are advantages of the private versus the central bank digital currency. Appreciate that. U.S. Treasury, I think that is odd. That is U.S. Treasury is not set up to regulate financial institutions. It has not historically been. The OCC, of course, is a regulator. The Federal Reserve is a regulator. The FDIC is a regulator. I think a proposal for a stablecoin issuer to be an IDI would, depending on the charter of the IDI, would go into, the regulator as under current practices. That could be a choice.
If I could, and pick up. Thank you. And pick up where Mr. Hollingsworth and Mr. Torres left off. I'd like to associate myself with much of what they said. I want to ask a pretty direct question. So the IDI recommendation, as you've said, is more or less to ensure safety and soundness and to guarantee the consumer protection mechanism if you have a stable coin, it can be redeemed for $1. I think you've said in various instances that if the reserve quality is high enough and there's redemption rights in place, that maybe that's not necessarily required. Did I hear that correctly, that there could be a world that you would agree with, which is say, hey, there are some who probably need to be IDIs, but if we define what a stablecoin is in a particular way, that's not necessary. Is that fair?
I think a stablecoin issuer, and these are all issues for further discussion, but a stablecoin issuer within an IDI framework that held capital and was subject to liquidity standards could have reserve assets that were not 100% cash.
Right.
Because of the capital and liquidity standards and the other standards. If it didn't have the capital or liquidity, one would want basically cash.
Yep. So there is
securities.
I agree. There is a world where we could have stable coins regulated as such that they do not need to be IDIs. And I think that's really important for a whole host of reasons, one of which is the diversity and inclusion aspect of crypto. It is a fact, as has been pointed out, that crypto has been disproportionately adopted by diverse communities, which is in contrast to other financial innovations, which typically benefit non-diverse communities disproportionately. I would argue that part of this is because the barriers to entry for diverse communities are much lower in crypto. And also, it gets around the two things that when the FDIC surveys the underbanked and unbanked, why do they remain unbanked? Two, minimum balance requirements. Minimum balance requirements, and two, they don't trust banks. They're unbanked. And so I think a fear I have with the IDI requirement is that we push our diverse communities and those who are unbanked into a banking relationship that they either don't trust or have natural reasons why it doesn't make sense. And so I think if we're going to preserve the innovation for all Americans, doing so outside of the IDI framework is something that we absolutely should be cognizant of. And with that, I yield back.
Thank you very much. The gentlewoman from North Carolina, Ms. Adams, is now recognized for 5 minutes.
Thank you, Chairwoman Waters and Ranking Member McHenry, for hosting the hearing today. And to Madam Undersecretary, thank you for your expert testimony and for answering our questions here today. You know as well as I do that industry, academia, and everyone in between has their own opinion on who should regulate cryptocurrencies and stablecoins. The report that we're discussing today suggests that for stablecoins, prudential regulators should be the primary federal overseer. So, Madam Undersecretary, are you concerned that there could be confusion if stablecoins are brought into the prudential regulatory framework, but other cryptocurrencies are not?
I believe there is a distinction in consumers' minds and investors' minds between what are unbacked crypto assets and stablecoins. And I think regulators and policymakers can actually try to reinforce that distinction with regulation, that stable coins that offer stable value actually can provide stable value. I think that's an important distinction to make, and I think regulation can help that. I'm not concerned that it introduces confusion.
Okay, thank you. So you've heard today that there is bipartisan desire to provide this industry the tools that it needs to grow in a strong and safe manner. So in your view, how can both Democrats and Republicans in Congress work together with the administration, industry, and other stakeholders to best provide those tools?
I think that various Congress members have been proposing parts of legislation to consider how to make stable coins more stable. I think there's a general acceptance of what the principal risks of stable coins for payments are. And there's discussion about what is the best regulatory approach for it, but there does seem to be some common acceptance of a need for regulation. And I think that there's an agreement that more consistent is valuable to promote innovation and competition. So I think these are issues for Congress to consider and balance the benefits of innovation with the cost, the risks to users and the payment system and financial system broadly. We are very happy to continue to engage in that process.
Well, thank you very much. And Madam Chair, I'm going to yield the rest of my time back. Thank you.
Okay. Thank you very much. The gentleman from Tennessee, Mr. Rose, is now recognized for 5 minutes.
Thank you very much, Chairwoman Waters and Ranking Member McHenry for holding the hearing, and also want to thank our witness for being with us today. As time is limited, I'm going to go ahead and dive right in. Undersecretary Lang, I wanted to follow up on a line of questioning on the importance of the dollar on the global stage. If Congress banned stable coins, do you think that stable coins would be developed in other countries?
Yes, I think stable coins would continue to develop.
And do you think stable coins would be pegged to other currencies rather than the dollar?
I think there would be the use cases would determine what it would want to peg to. But if the US dollar is supported by not stable coins or technology, but by the country's respect for rule of law, it's the infrastructure, the economic potential of the country. But no doubt, if you created currency or payment systems that are separate and independent, it would take away from, what could have been additional contributions to the role of the dollar.
Sure. The US dollar, of course, is the world's dominant reserve currency, and as I think has already been mentioned, approximately 59% of all foreign exchange reserves are held in US dollars. Currently, the $5 pegged stable coins represent 94% of the market. Undersecretary Liang, what are the benefits of having stable coins pegged to the US dollar as opposed to other currencies?
I think the reflection of that many of the major stable coins being pegged to the dollar reflects that the dollar is the primary reserve currency. And I think for policy purposes, policies to promote the strength of the dollar are critical, and stable coins will continue to peg to the dollar as long as the dollar remains strong and reflects.
So is the inverse true, that having a majority of stable coins pegged to the dollar might help to preserve the dollar's status as the world's reserve currency?
Yes, I think it is a positive contribution.
And are there stable coins that reference other currencies such as the yuan or the euro today?
The Central Bank of China has issued a digital currency, yes. But
according to a recent staff working paper released by the Federal Reserve titled Stablecoins, Growth Potential and Impact on Banking, quote, stablecoins served as a digital safe asset while more speculative crypto assets were temporarily in free fall during the crypto market crashes in March of 2020 and May of 2021. The paper adds that these episodes demonstrate the potential for stablecoins to serve as a digital safe haven during market distress. You testified that stablecoins may pose systemic risk. Do you know what the size of the market for stablecoins is today?
Currently, stablecoins are roughly 170 billion, but their value, but they are used in many transactions. Their value does not represent their importance in the crypto asset market because they are used in many transactions, and that doesn't, as a share of transactions, it's much higher.
To give some contrast, what is the size of the money market funds today?
Greg, the money market fund industry, I would guess, is in the $4 trillion range at this point.
And then similarly, what is the market for U.S. Treasuries today?
So the market for U.S. Treasuries, I should know this. It's larger, much larger than stable coins.
Right. So is the stable coin market really big enough to pose systemic risk? And do these, the incidents in March of 2020 and May of 2021, those market events, they tend to show that adequately capitalized stable coins with appropriate safeguards in place can, as the Fed's working paper states, quote, serve as a digital safe haven during market distress and provide a level of stability that's on par with traditional forms of safe value?
Yeah. So the PWG report does not suggest that stable coins currently are a threat to financial stability and pose systemic risk. It is the ability for stable coins to scale up rapidly because of network effects once they become adopted. Then it could pose a systemic risk.
Thank you, Undersecretary. I see my time has expired. I appreciate your questions, and Madam Chairman, I yield back.
Thank you. The gentlewoman from Texas, Ms. Garcia, who is also the Vice Chair of the Subcommittee on Diversity and Inclusion, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you for this very important hearing. And Undersecretary Lang, thank you so much for your patience and your endurance. The end is in sight. We're coming down to the last few members, and votes are taking place, so I'll have to rush through mine. But I just want to quickly follow up on the Mr. Rose's question. The 170 billion market a share that stable coins represent. How many consumers would that be? I mean, how many people are actually using this?
That is a great question. Would have to get back to you on that.
How many investors does it represent?
I do not know.
So we just know the growth in value, but we really don't know if we're talking about 1,000 consumers or 2,000 investors. And I just wanted to say that to keep things in perspective, that we're saying it's growing. We need to do something. But is it really? I mean, who's really using it? And I ask that because the report states that legislation should require stablecoin issuers to be registered as insured depository institutions in order to participate in issuing currency. Well, I understand the reason behind this, and I think I do support it. I want to explore the possibility of this requirement preventing smaller issuers from participating in market activity. You know, we always have challenges, and I think other members have asked you about barriers for unbanked and smaller providers, smaller issuers. So I don't want us to create a system that's just going to repeat what the banks have been doing, which is leaving us out. Mm-hmm. And if we don't know who's using it now and who's investing now, I'm afraid that we're just going to repeat ourselves. So my question is, what can we do to make sure that the little guys or the little gals are not left out while allowing only the big banks, coin issuers to participate?
Right. So the proposal for an IDI institution does, of course, raise some costs of entry for this business, but I believe that there is a lot of flexibility in a new charter. So
yes,
it's not designed to reduce.
But I just want to be clear. My question is, how are we going to make sure that there is equity? I think Mr. Meeks also asked this question, that there is true equity and that it will be accessible, and that we're not just putting together another system that's going to leave the same people out that have always been left out. Because you've mentioned remittances. And that's a laudable goal. I think that's a lot of work to do before we could get there. Because you mentioned in terms of things that are good about stable coins and creating a new payment system would be lower costs. But I'm worried about conversion fees. I'm worried about accessibility to be able to get those funds. I mean, if I'm in Mexico and I'm a poor person waiting for my relative here from Texas to send money, you know, how do I convert this stable coin into money that I can then take to the market to buy the glass of the jug of milk? I mean, you know,
So
what
that is exactly
we think
the
this
pilot programs that stablecoin issuers and wallets are testing. Can you improve the speed and reduce the costs of these remittances between, say, Texas and Mexico?
But you understand that a lot of people don't use wallets, that, you know, a lot of folks don't have cell phones. That's been my pet peeve of the entire vaccine rollout. It's so tech dependent.
Yeah.
There's people in my district I'm 77% Latino district that don't have Wi-Fi and don't have the tech capacity to do that. So once again, we're creating a system that's just going to help those that already have and leave the have-nots out of the picture. So I just want to be mindful that 170 billion does not mean it's 170 billion people that are using it.
No, absolutely, absolutely. And I share your concern about not being able to, that not all households can access this. But I believe greater competition is probably the best way to improve the payment system, and that stable coins are a competitor to the existing payment system. We do not, I would say we won't know where the payment system will look like, you know, many years from now. But competition is probably, you know, the strongest force for improving the payment system over time and meeting the needs of all consumers.
Well, thank you. I see my time's run out. Madam Chair, I yield back and I'm running to the floor to vote. Thank you.
Thank you very much. The gentlewoman from Michigan, Ms. Tlaib, is now recognized for 5 minutes. Is Ms. Tlaib on the platform? Thanks. The gentleman from Wisconsin's Mr. Style is recognized for 5 minutes.
Thank you very much, Madam Chairwoman. Appreciate you holding today's hearing on a really important topic. As we've seen, digital assets are already transforming our financial system. And I think we really have an amazing opportunity right now to put in place the legal foundations that are going to support continued innovation in long-term growth, and in particular in the United States. And so I'm concerned if we continue down a path of ill-fitted regulatory constructs, we may be moving this innovation offshore rather than coming with the approach of how can we help? How can we help bring innovation here into the United States? And so with that background, Undersecretary Leong, we've had a great conversation today about digital asset firms, how they're currently, in particular, state regulated. And so besides the money transmitter regimes, as we've noted today, several states have developed pretty sophisticated approaches to digital assets regulation. As we noted in New York, the BIT license allows firms to apply for limited purpose trust charters under state laws. But I've noticed in many ways your report didn't really address the regulatory framework in states. And so earlier, I think you mentioned that you talked to state regulators and analyzed state frameworks. Is that correct?
We did consider state frameworks yes, we considered state frameworks.
But there's not really an actual analysis of state frameworks included in your report. Is that correct?
No, we did not include discussion of state framework analysis.
And so do state chartered depository institutions have a primary federal regulator? And are they subject to federal banking regulations?
I think federal banking regulations can apply to banks that are state chartered.
Okay, so
Some of the BIT licenses are, as you said, limited purpose banks or charter banks, as I understand them, or trust banks. Yeah.
I appreciate that. So I'd like to go back a little bit in time here earlier in the hearing, back to a response you gave to my colleague, Mr. Loudermilk's question on the PWG approach. I think you referenced, if I recall correctly, you said it builds upon existing state laws. But as we just noted, the report doesn't really analyze state laws. There's definitely a federal primary approach. What do you mean by builds upon state laws?
Yeah. So one is currently all stablecoin issuers and custodial wallet providers are subject to our money service businesses, and money transmitter laws apply to them. That is at least 49 state regimes. The proposal does not replace the state money transmitter with a federal money transmitter proposal, which I understand maybe some legislators are considering, but it could build on that and require a set of risk management standards that could apply to custodial wallet providers. In that sense, it builds on the state frameworks. Also, insured depository institutions they can be state chartered or federal chartered. That's in the current system. But even a state chartered bank has always had some federal layer on it for, deposit insurance or some of the other features of a traditional bank.
Yeah, I just think it's a really interesting topic here, so I'm just trying to flesh it out a little bit. So if we look at kind of a construct that would privilege federally insured depository institutions, how would you account for the existing state-based regimes that already apply to incumbent firms? It's a little bit what you're talking to, but kind of, could you hit that point for us?
Yeah, so I think that would be something that would be that needs further discussion. The current existing state charters, at least some of them, do not provide the supervisors of those institutions a sufficient visibility into the broader payment arrangement. And so that's where we're looking to fill that gap.
Yeah, understood. So Undersecretary Liang, I appreciate your time. I think it's just really important that we get this right. I think we're digging into the right topics. I think the key here is to make sure that we don't overregulate, that we encourage innovation in the United States of America. I think we're at a moment in time where there's great opportunity. We don't want to overregulate this and throw the baby out with the bathwater on what is clearly a really interesting space of development. And so, cognizant of the time, Madam Chairwoman, I'll yield back.
Thank you. The gentlewoman from Pennsylvania, Ms. Dean, is now recognized for 5 minutes.
Thank you, Madam Chair. Thank you, Undersecretary Liang, for testifying today and for all of this valuable information. When we had a hearing on digital assets in December with witnesses from the crypto industry, I talked about my concerns over the extreme volatility that we see in the market. And I asked the panel if we are at risk of a bubble akin to that which was triggered in 2008 financial crisis. I'll note that the volatility that we've seen in the 2 months since the hearing has certainly not reassured me. But at the hearing, in response to my question, Mr. Brian Brooks likened this volatility to what we saw in the first 100 years of the stock market. While it may be turbulent in the early days, the long chart is up and to the right, he said, just like the US equity markets. Well, that may be true, but I'm worried, and that doesn't quite tell the whole story. Undersecretary Liang, what are your thoughts? Are we at risk of another bubble?
I think many of the digital assets, especially those that are unbacked, the price volatility is very high. And investors absolutely need to understand whether those investments are appropriate for them and need to understand that. The risks, the bubble, the costs of a bubble are high when when the prices are supported by financial leverage in the system, or they're connected to traditional highly levered banking institutions that could magnify the impact of any price decline in crypto assets. Currently, investors in crypto assets and digital assets, this is separate from stable value, but in terms of the digital assets with highly volatile assets, are bearing the losses and the gains largely on their own. But we definitely are concerned that those do not cause problems for the broader financial system or the economy, where consumers who are least financially and economically resilient would bear the costs of a decline in prices, of a bubble bursting. But to the extent that these prices are within the sort of digital asset space, the implications of the price decline are less severe for the broader economy and less severe for the consumers that we really are most vulnerable to these kinds of outcomes.
Thank you. That's really helpful. And I wanted to build on that issue of leverage. You've talked today about your concerns with the systemic risk posed by the buildup of leverage against digital assets. In your written testimony, you stated, and I quote, "As we saw in 2007, 2008 financial risk, and most that preceded it, leverage can play a key role in catalyzing and accelerating financial instability." And you note that the administration is still working to understand the role that leverage plays in digital asset markets. Can you give us any further clarity along those lines of leverage and what the administration is recognizing?
I think it's early to say very much, except to highlight that it is a topic of high importance, because high leverage in a volatile asset can cause problems for the financial system and the economy. The Financial Stability Oversight Council is following this, looking at it. I think it's too early to say that we have conclusions.
And in terms of the investor base, I think some of the reports that I've read, it is quite diverse, which makes me worry about those that would be potentially at risk. Can you talk about the investor base? What do we know about the demographics?
I think the demographics of, I think there are concerns about the demographics if they, some surveys suggest more minorities, more lower income investing in these assets. To the extent those surveys are accurate, that is of great concern, because as we mentioned, these prices are highly volatile. But this is a space that is not regulated, and I think the information about who the investors are and the transactions is actually quite limited, and we're relying on various surveys.
Right. Well, very helpful. Thank you, Madam Chair. My time has expired. I yield back.
Thank you. The gentleman from South Carolina, Mr. Timmons, is now recognized for 5 minutes.
Thank you, Madam Chairwoman. And first, I want to thank the Undersecretary for her work on the President's Working Group and for being here with us today. I want to first touch on a subject many of my colleagues have brought up with you today, whether stablecoins should be regulated and housed solely within the banking system or not. I know that your report speaks to this and you have discussed it at length in today's hearings, but I want to ask you myself, do you and the PWG see stablecoins existing exclusively within the traditional banking system?
I think the recommendation is to require the issuer to be an insured depository institution with a flexible regulatory framework that is lower cost for simpler business models.
Were there other options discussed in the PWG?
Yes, of course, other options were considered in developing a recommendation. I think the principles of providing clarity consistency and a comprehensive framework is what led to this particular recommendation. Recognizing that there is some flexibility in the IDI framework. And there was no one was recommending that a stablecoin issuer be regulated like a traditional commercial bank. But the IDI charter has the flexibility to provide some supervision and regulation that is adjusted for the risks of the activities of the stablecoin issuer.
I think it seems obvious to me that regulating a product under a regime designed for something completely different, while it may solve some problems, it's likely to create many more problems and stifle innovation and investment in an emerging industry that shows great promise. I guess my question is, what do you think the obstacles are that stablecoin issuers are likely to face if PWG's recommendation to regulate them like banks comes to fruition?
I think it would be, it would be on the regulators to try to reduce the costs for an issuer that is not a traditional bank. And they can have some flexibility to keep those costs down. And I think that's the function. The stablecoin function of providing payments is a bank-like function, and that's why the recommendation was to use the bank framework. But recognizing that a stablecoin issuer is not likely to make loans and extend credit and engage in fractional reserve banking, the regulatory system can be adjusted to not apply all the kinds of rules and regulations that would apply if you were to make loans.
I think you're making a lot of assumptions on their ability to thread the needle. I personally think it'd be better for Congress to do their job and to craft policy specifically for this new emerging industry. What are your thoughts on that?
Yeah, so I think that's clearly an issue for Congress to certainly discuss. Again, we were trying to promote a consistent framework, less fragmented. We were just less compelled to introduce yet another regulatory scheme. And to the extent an existing tested framework is available and could be applied, that seemed to be the preference of the group.
Sure. Well, I would like to think that Congress might be able to do better. Disruption is a natural part of a free market economy. New products and technology emerge and shake things up. It can sometimes lead to short-term pain for entrenched industries, but it forces adaptation and almost always leads to better products for consumers and more prosperity for our communities. I urge my colleagues to really find a better path forward. And with that, Madam Chairwoman, I will yield back. Thank you.
Thank you very much. The gentlewoman from Michigan, Ms. Tlaib, is now recognized for 5 minutes.
Thank you so much, Chairwoman Waters, for holding this important hearing, and to the Undersecretary for being so patient with all of us, for presenting the working group's report. I thank you so much for the important work. As FinTech becomes an entry point for the underbanked and unbanked to access financial services, we must ensure that we're putting in place, adequate protections on behalf of our constituents.
Whoops. I believe we lost her connection. She lost her connection.
All right, we're going to hope that she gets back in, and we're going to go on to our next member at this point. The gentleman from Illinois, Mr. Garcia, is now recognized for 5 minutes. I don't see Mr. Garcia on the platform anymore. The gentleman from Massachusetts, Mr. Auchincloss, who is also vice chair of the full committee, is now recognized for 5 minutes.
Thank you, Madam Chair.
All right.
And Undersecretary, I appreciate your stamina in a long hearing and your thoughtful answers. And I've learned a great deal from your memo and the PWG and my colleagues' good questions from both sides of the aisle. And I want to talk about 3 different domains of risk that I think we can bucket this conversation into. The first near-term bucket is prudential risk, is run risk and payment risk of stablecoins, which you've articulated and answered a lot of questions about. It seems like from your previous answers, I believe specifically to Mr. Himes, you feel like run risk could be mitigated with a simple registration process by stablecoin issuers, where they were audited and disclosed, not as IDIs, but just in a transparent auditing process, but that you feel like payment risk really is what requires the IDI. And I want to press on that a little bit because it's not really clicking to me. I understand that stablecoin is used as a medium of exchange, but only really within the crypto economy. So why do we feel like there needs to be a federally insured regulation around a medium of exchange that's really quite constrained to the crypto economy? And when other fintech innovations like the PayPals or Venmos of the world weren't subject to the same type of regulation.
So thank you for that clarifying question. The premise of the PWG report is that stablecoins will continue to try to be converted to fiat currency, work outside the crypto economy, that it will not only be used to facilitate crypto trading. An example is cross-border remittances, which are translated into currency in some sense at both ends, right? And so it then becomes part of the payment system, the way that money is transacted in an economy.
I would encourage us then to investigate that premise further and try to find a way to mitigate payment risk that's in keeping with that premise and more narrowly tailor it. I'm not convinced that we need to have it fully an IDI partly because we risk regulatory capture by the banks. Part of the promise of Web3 is that it's disruptive in a good way to the financial services system. And I worry that layering on these requirements that may be unnecessary given the actual payment risk could actually just be a boon to established incumbents. But this leads us, your answer, to our second kind of big bucket of risk here, which is systemic risk. And my colleague, Mr. Hill, asked about this, and you answered that you really did not see this stablecoin economy as being a systemic risk at this point. It seems that FSOC should really be doing persistent monitoring of that, right, and reporting back to Congress about whether it's becoming so. You also suggested that interoperability between stablecoins could help mitigate some of that systemic risk. Are there measures that you would recommend beyond FSOC monitoring and interoperability standards that could mitigate systemic risk, or is there a firewall that could be set up or at least monitored to forewarn of it?
Ideally, so I think this is always about trying to identify the next potential source of systemic risk, and the way that regulators approach that are to look at the common sort of vulnerabilities like leverage. So if there were a way to measure and quantify leverage in this system, that would be an early warning indicator. I think in the current environment, that's not easily done.
Another reason why registration, auditing and disclosure would be helpful, but not necessarily, you wouldn't need to have IDI status to be able to track leverage. So you could do just basic registration to accomplish
Yeah, so the stable coin itself as registered, that itself is not leverage. It's the use of the stable coin as collateral to lend your stable coin so that someone can use it to purchase on margin. And so because it's the stable value provides a stable value collateral.
So that
that's
might be more the custody wallets then that have to be disclosed.
Exactly.
So custody wallets and stablecoin issuers are registering and disclosing and auditing. All that seems sort of makes sense to me. Again, it's just the IDI lead. Finally, Undersecretary, in the last couple seconds, just do we need a CBDC in order to address this third bucket of risk, which is the United States loses its preeminence on the global stage as the world's reserve currency? I loved your answer about how it's more about the liquidity of our markets. It's more about the rule of law. This is not a tech fix. And the CBDC paper, and I appreciate the work the Fed did, struck me as a solution in search of a problem. Can't we just accomplish a lot of these aims with better stablecoin regulation and with compounding our existing strengths as a nation?
Yeah, I guess I would, as you say, I would repeat my previous answer that the strength of the US dollar is based on its country's laws and governance and its markets and its economic potential. Technology can play a constructive role, but it is not the primary indicator.
Undersecretary, thank you again for your testimony today. Madam Chair, I yield.
Thank you very much. I just want to make sure that Mr. Garcia and Ms. Tlaib left the platform and that somehow they were not frozen out of here. So it's about time for us to close down. And I'd like to thank our witness for her testimony today. Thank you so much for the time that you've spent with us. Thank you so much for your patience. Thank you so much for the way that you were able to address all of the questions that were asked to you. So without objection, all members will have 5 legislative days within which to submit additional written questions for the witness to the chair, which will be forwarded to the witness for her response. I ask our witness to please respond as promptly as you're able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing is adjourned.